Marking the occasion, the Prime Minister said now EVs made in India will run in dozens of countries around the world. Let's listen in.
Make in India, make for the world. हमारे उस लक्ष्य की तरफ एक बड़ी छलांग है। आज से भारत में बने इलेक्ट्रिक व्हीकल्स 100 देशों को एक्सपोर्ट किए जाएंगे। साथ ही आज हाइब्रिड बैटरी इलेक्ट्रोड मैन्युफैक्चरिंग भी स्टार्ट हो रही है। आज का ये दिन भारत और जापान की फ्रेंडशिप को भी नया आयाम दे रहा है। साथियों, भारत के पास डेमोक्रेसी की शक्ति है और भारत के पास डेमोग्राफी का एडवांटेज है। हमारे पास स्किल्ड वर्कफोर्स का बहुत बड़ा पूल है। इसलिए कि हमारे हर पार्टनर के लिए विन विन सिचुएशन बनाता है।
Meanwhile, NDTV Profit's Danish Anand spoke to Maruti Suzuki's ED Rahul Bharti on the company's plan to service 100 markets for the sale of e-Vitara. Let's listen in.
Today, you have officially entered the EV space and you're starting from exports. First of all, what is the rationale behind this decision that instead of launching the car in India first, we are focusing on exports?
See, there are about more than 100 markets that we have to service. So some sequencing has to happen. And we'll try to cover all markets, but we'll try to cover all of them within this financial year itself.
So how important is the Indian EV market for you, considering that your local competition, the other companies, they already have many EV products, and legacy player like Maruti is entering EV space after such a long time. So how do you plan to really compete with the local companies here?
Having a product is not sufficient. One, you should have an excellent product. Two, you have to back it up with after purchase support. And Maruti Suzuki has devised an E4Me program, which gives customers a lot of confidence. If anybody is in doubt whether he should buy EVs or not, our E4Me campaign ensures that he gets total confidence and peace of mind. For example, first, of course, the product. So it's a product which is designed fresh on an EV dedicated platform. It's not an IC engine converted platform. An IC engine converted can have several design compromises, but it's freshly designed as an EV. It has several safety features like fire safety, advanced fire safety, advanced crash protection, 7 airbags as standard, and many more such features, 500 kilometers range. The performance is really good. So that's about the product. But at the same time, customers are worried about what happens. They have many apprehensions. So Maruti is here to give them total confidence. The first thing is we'll have a home charger with every car. We will have fast chargers in at least the top 100 cities of India. And while the top 100 cities account for more than 90% of sales, we will go 10x. We will cover the 1,000 cities with service support. For those service, we have trained technicians. And we are going one level deeper, and only a market leader can possibly go to that level of depth. We are covering about 130 ITIs in the country to churn out 4,000 trained service technicians who can handle high voltage products like EVs or hybrids. 4,000 every year, and at the end of that, they're free to join anybody, whether Maruti Suzuki or competition. But at least it will help increase BEV adoption in the country.
Right. So considering that there is only just one production line of which is dedicated to EV manufacturing, in the months or years to come, what are your bigger plans for EVs? How do you plan to bring up and scale up the EV production in comparison to ICE?
So we have three production lines in Gujarat, each one of capacity 250,000. Our third line is making this e-Vitara. It is flexible to make both EVs as well as IC engine vehicles. And we will be adding a fourth line, which will be an EV dedicated line. So we have sufficient capacity.
Meanwhile, let's take a look at how the markets fared today. We saw benchmark indices falling sharply by over 1% as investor sentiment weakened after the US drafts notice on additional tariffs on Indian imports. Sensex dropped 910 points to 80,700 level, while the Nifty declined to 24,690. All sectors closed in the red, barring FMCG. But to bring us more, my colleague Puneet joining in with more details.
Well, it was a day which was under pressure for the Nifty, and we've seen that across the day today, with the advances just at roughly between 420 to 430 stocks and the declines at roughly around 1900 stocks today. We saw continuous pressure. The Nifty lost over 200 points from the day's high, and that pressure continued in the mid-cap and the small-cap index as well. For the Nifty specifically, it closed at its lowest point over the last 7 days, and barring the FMCG index, largely we saw all the other indexes being in the red today as well. Some notable stocks which were lower were Vodafone Idea as well as JK Paper. We saw some gains on stocks like IPCA as well as Craftsman Automation on the BSE 500, but that largely seems to be a day which was under pressure and continued to do so. Apart from that, we've seen Shriram Finance as well as Sun Pharma fall the most, and that was specifically for the Nifty. I mentioned Nifty fell 200 points from the day's high, but something like a Midcap 150 saw drags from Vodafone Idea as well as FACT as well. The Midcap 150 has fallen for the fourth consecutive day, and there seems to be any kind of lack essentially of a particular trigger to boost the markets going forward. Apart from that, we also saw the small cap 250 fall nearly 2%, and that was led by Swan Energy, Balrampur Chini Mills, amongst some of the key stocks that impacted the small cap index today. Finally, in terms of sectors, we've seen the realty index largely, along with the PSU Bank and oil, have the major essentially drag on the Nifty, while we've seen that all sectoral indices largely continued to be under pressure throughout the day as well. The Nifty FMCG was the only one which offered some kind of solace, up 1% in trade today. We saw some positive gains on stocks like Britannia and as well as something like an HUL, but that largely seems to be one of the key aspects of a continuous pressure that we've seen across the market, and we'll be hoping of some positive start on Thursday morning, with tomorrow being a market holiday. So very happy Ganesh Chaturthi to all of you.
And meanwhile, plenty of primary market action today as 4 companies made their market debut. Shriji Shipping, Gem Aromatics, Vikram Solar and Patel Retail all listed on the bourses. Anushri now joining us with more details.
4 new IPOs which have listed today. Firstly, I'll start off with Vikram Solar. Now, this is amongst the largest renewable energy space players that we are looking at, with a production capacity of 4.5 gigawatts. Now, total size of this one was about 2,079 crore with a fresh issue component of 1,500 crore. As if we saw that the IPO had received decent subscription of around 56 times. So this was in focus. Along with that, something which clocked in strong gains today was Patel Retail. Now, if you look at this company, this is a supermart chain with about 43 outlets across suburban Maharashtra and under the brand Patel's R Mart. Now, this total size of this one was 243 crore. IPO consisted of 217 crore of a fresh issue size and was subscribed about 96 times at the end of day 3. Gem Aromatics, also another one in focus, Mumbai-based manufacturer of essential oils, aroma chemicals and other specialty ingredients as well. This was a relatively smaller one with a 451 crore of a total issue size with a fresh issue component of 175 crore. This one had also received a 30 times of an IPO subscription level. So all these 3 that we've seen have received decent subscription numbers as far as we've seen. The last one is Shriji Shipping Global. Now this majorly operates on the west coast of India, focusing on non-major ports and coastal trade. IPO proceeds of PC will majorly go towards buying dry bulk carriers in the Supramax category. If you are looking at, total size of this one was 411 crore, and this included this is a total fresh issue of that we are seeing about 410.7 crore, with IPO receiving about 58 times the subscription that we are seeing. So these are the 4 listings in focus today.
Thanks for that, Anushi. And moving on, according to a report by the Global Trade Research Initiative, the US's new 50% tariff regime is set to hit India's exports hard. The move is expected to weigh most on labor-intensive sectors like textiles, gems, jewelry, shrimp, carpets and furniture, making them less competitive against global peers. My colleague Rishabh now joining us with more details from GTRI and FIO's statements and the latest on the Prime Minister's office deliberations. Rishabh, what are you hearing?
Right. What we're picking up is that a meeting is underway between the PMO as well as key economic ministries, including the Commerce Ministry. What we're hearing is that talks will revolve around the status of India's
Right, we seem to be having some connection troubles with Rishabh. We'll try and get back to him in just a moment. But this is the latest that's coming in right now. This is a report that has come out by the Global Trade Research Initiative saying that the US's new 50% tariff regime will hit India's exports hard. We're looking at most amount of impact in labor-intensive sectors like textiles, like gems, jewelry, carpets and furniture, making them less competitive. Let's just move on now, and we'll try and get back to Rishabh in just a moment. But the deadline for the potential 50% tariff from the US is set to expire tomorrow. But to understand the gravity of the situation, we also spoke to several prominent figures, including the President of Seafood Exporters Association of India, the Vice President of FIO, the President of the Textile Association of India, and the Chief Economist at Yes Bank. My colleague Hiral asked them about the ongoing uncertainty, especially given the initial anticipation of a 21-day negotiation window. Let's listen in from this insightful discussion.
We're not really changing our GDP numbers yet. Because I think the critical issue is, yes, the tariff takes hold, but on the other side we also have a GST regime that is coming on. So we are talking about 2 different segments of the economy, one being very significantly negatively affected, which is the export segment, and the downside implication of that on employment in the country, because most of the exports to the US that we are talking about is also labor-intensive exports. So there is a downside implication in terms of the employment as well as the purchasing power of the population. But on the other side, we are likely to neutralize that to a certain extent by the GST regime. So it's a very difficult story at this point in time, and there are 2 diverging sort of pulls that are present in the economy on the growth side. And from that perspective, we have still not altered our headline GDP number, though some of the internal numbers may actually be changing. The other important issue is that while the GST positively impacts from a price perspective the services sector, we still don't have tariffs on the services sector, and that restricts itself to the goods sector. So that should be another enabler in terms of the headline GDP number that we look at. In terms of the overall hit purely from the tariff, we are estimating a 0.2 to 0.4% sort of hit, depending on about a 20% sort of exports to the US from India being critically impacted. That's the first round hit that we are estimating.
So 0.2 to 0.4% in terms of GDP hit, Mr. Pan, is basis 25% tariff. So you're saying basis 50% tariffs?
So it's basis the 25% tariff. It's very difficult to assess what happens in terms of the 50% tariff. I think other guests on your panel will be more sort of suitable to answer this particular question. So at 25%, 25% tariff, what I've heard from exporters is that they'll possibly be able to absorb a certain bit, and they would not really cancelling orders. But the situation may drastically change with the 50% tariff, and therefore I would expect other guests on your show to actually sort of pin down in terms of the sectoral perspective how it impacts the overall performance of the sector.
Absolutely. So that's going to be more important. In fact, let me also get in Ravikant Kapoor, Vice President for you. Ravikant, welcome to the show. My question coming to you is, negotiations have been going on. You have, as an association, you have been in touch with the Commerce Ministry as well. What is it that you're picking up now from an impact perspective, representing the exporters? Do you think there is a way forward from here on?
There's always a way forward. But I believe that we have to take it one by one. We have to look at the current situation as it is. It is really a major disaster for exporters to the US. It's still a fresh wound. The pain will set in. It will take some days and weeks, probably some months, if they do not come to any settlement. And for the exporters, we do not see any alternative, especially the ones who are levied the 50% reciprocal plus the earlier normal duties. It is something that we have to now look at: damage containment, hand-holding by the government. The first thing that's going to hit you is what do you do with all your inventories? What do you do with your documents which are of goods on the high seas? It's going to lead into a kind of a financial situation where a moratorium will definitely be called for and should be done within a day, because people need to know what they are going to do. It's also going to affect employment in a big way, because the ones that are paying duty are apparel, they are leather, they are carpets, they are shoes and chemicals. So these are the ones where there are big employment running into crores of people. So how are they going to be managing it? And a lot of this is going to the US, which has been a primary market.
Meanwhile, the Communications Ministry has sought an extension on America's postal duty order as India Post is facing technical and operational issues. This is ahead of the order by the US scrapping duty-free parcels valued up to $800. The request has been placed with the Commerce Ministry and the MEA. My colleague Aishwarya Patil now joining me on the phone line with exclusive story details and more details on this. Aishwarya, over to you.
Well, as you rightly mentioned, the U.S. did pass an executive order which earlier had exempted up to $800 of duty-free allowance. Now, what the Communication Ministry has done is requested the Ministry of Commerce as well as Ministry of External Affairs to extend the implementation time of this U.S. Postal Service executive order. Now, India Post is saying that in order to streamline the operations and also to ensure technical readiness, that is the reason why they need an extension for all of this. Essentially, what the executive order does is that all of these parcels that are being sent to the U.S. under $800 or so will now not be able to be processed by a lot of these airlines as well, because what they're asking of the airlines is to collect duty on behalf of the U.S. government and then get these parcels to the U.S. And airlines such as Air India, Lufthansa Cargo, Swiss Cargo are all unwilling and do not have the systems, as they say, to collect the duty for U.S.-bound emails as well. Of course, a little bit of a background, if you will, on this order is that it was effective. The order came through and it is effective. It will be effective from August 29, 2025 for all countries, including India. India Post has already suspended all the parcels from the 25th of August. Going forward to the US, only letters and documents or gift items under $100 will continue to be accepted going forward from here. So that's the story so far. We'll keep you updated as and when we hear on the developments further from the ministry sides as well.
Right, Aishwarya, thank you so much for that update. The Communications Ministry seeking this extension will continue tracking these key developments and bring you all of the details. Moving on, Vijay Sales is betting big on the festive demand and GST rate cuts. Director Nilesh Gupta told NDTV Profit that he expects sales growth of 15 to 20% during the festive season this year over the last. Here's a snippet on how the retailer is gearing up for celebrations.
Today, we are at a very special occasion. We are at Vijay Sales store talking about the new GST reforms and the boost in consumption that is to follow, and of course the festive demand and how are the sales looking like. And to discuss as to how things are faring at Vijay Sales, we are joined by Nilesh Gupta, who's the director at Vijay Sales, joining us now. Always a pleasure speaking with you, Mr. Gupta.
Thank you for having me here.
My first question to you is that, I want to understand that with regards to this new GST reform that we're talking about, where GST will come from 28 to that 18% mark for ACs, plus your 32 plus inches TVs as well as dishwashers. How is the industry viewing this, and how is this move being welcomed by the industry?
So I think the industry is viewing this as a Diwali gift by the government. Definitely, both the categories are very important.
Yeah.
The 32 plus televisions as well as the air conditioners.
Right.
And especially in the light of the air conditioning summer season not doing so well because of the rains, erratic rains, I think this is going to be a real breather for us, and it will definitely boost the sales.
In terms of the overall view as well, from a Vijay Sales point of view, from a retailer point of view, how do you think that this consumption boost, it's not just GST alone. There's lots happening that the government is in fact doing to boost the consumption, right? There was income tax cut, there was also rate cuts that's come in, there's 8th pay that's going to come in, plus this new GST reform. Lots, done by the government to boost the consumption. How do you think this will incrementally benefit Vijay Sales? If you can give us a perspective in terms of percentage as to what growth can come in from this consumption boost.
So what we are seeing is already the income tax rate cuts which were announced in the finance budget has translated into extraordinary sales for us. So the sales have gone up, and we are already seeing, in spite of a poor summer, we are already seeing a growth of around 10 to 12%, which otherwise would not have been possible. And now with this GST cut coming in, the positivity all around happening in the country, and the very fact that we are able to stand on our own irrespective of what's happening outside, I think it's a very positive impact. And in consumer durables especially, what matters most is not whether the consumer has money or not, but what matters is sentiments. So right now the consumer sentiment is up, plus he has money in the pocket. So it's a double whammy. So we expect a real good sales to begin once the GST sets in.
And that's all the time we had on this edition of Profit 360. But before we go, on the eve of Ganesh Chaturthi, leaving you with some lovely snapshots as the state of Maharashtra gears up for the festivities.
Tech has changed, so should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company? Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Puneet Javeri, and we're going to today talk about an auto company which is guiding for 20% sustainable growth, or rather, let me change that a bit, tweak that a bit. They're talking about 2x the growth of their industry, and it's on a very small base. They're tapping into export as well. So all of that likely to aid the numbers overall. But let me start off with what I want to know with regard to SJS Enterprises. Very, very strong clip of growth is what they're guiding for. I want to know whether they're doing the 20% sustainably is what one can expect over the next 5 years. The second piece is with regard to Walter Pack. Now this has been, this acquisition has dragged the business a little bit where Q1 FY26 is concerned. I want to know, and that's because of client concentration. I want to know whether that can turn a corner and how quickly can it do that. The third piece is with regard to client concentration. Is there a thought process within the company to acknowledge that and to change that is what I'd want to understand. Fourth one is with regard to margins. They do 26% margins. So high growth clip plus high margin plus a unique business. It meets all of those parameters. I want to understand whether those margins can be maintained and what the downside risk could that well be. Fifth piece is with regard to growth. Where will it come from? Current client cohort or a change in product mix, or a little bit of both? I'd want to try and understand some of those levers. Sixth piece is with regard to competition and moats. And I'm rushing through this because we've already done the interview. It's a long one and we want to make sure that you listen to the entire interview. So that's the sixth piece. The seventh piece is with regard to CAPEX and revenue visibility. how much of capex is getting penciled in, and how much can the top line go to given this capex. So no future capex till what point in terms of top line. All of that and more on KYC today. Let me start off with about the company. What it does, it designs, develops, manufactures decorative parts for vehicles and appliances. I'm going to quickly tell you briefly what it means. Your car dashboard, on it there is of course the speedometer. They manufacture that part of the car. They manufacture the glass on top of it. So all of those parts. Your steering wheel has the logo of the car on it. So does your two-wheeler, and therefore all of that is what they typically manufacture. Logos, overlays, dials, all of these. And it's a fast evolving business, because if you see some of the new age cars which are coming through, and some of the more expensive ones, the higher ticket ones, they have digital logos as well. So all of that is what they've pivoted to. In terms of product categories, that's quickly coming up on your screen. It has decals, graphics, 2D dials, 3D dials, which is typically your display on the car, and the branding on the vehicle. Domes and 3D badges, overlays, which is typically your logos, different types of logos both in 3D as well as in 2D, aluminium badges and in mold parts, which is high quality, durable branded parts within a vehicle on the appliances of the vehicle, giving it its nice shape, or the branding inside the car. All of that is taken care of. Optical plastics and cover glass, which is lots of glasses all around the car as well as on your other appliances. I'm restricting this to cars, but they also do other appliances, and that's a fast growing piece. So for example, your two-wheeler, on top of the dial you'll have the glass, which is what some of this is. The lens mask is typically the mask on top of, say for example, your headlight on the car or the bike. The mask on top of it, which is a transparent plastic mask, is also manufactured by them. Chrome plated, painted parts on the exteriors, handles, etc. All of that is taken care of by them. The aftermarket transformation. Now, this is a large market. We've come to acknowledge it. And the aftermarket, there are a lot of customers looking to transform their vehicles, make it look newer, jazzier, cooler. All of that is taken care of by them, and illuminated logos. I did speak about that. The revenue mix quickly coming up on your screen. Two-wheelers is around 39%, currently was at 34% in FY25. Passenger vehicles around the 37 to 40% number. Consumer is around 18 to 20%, and others is around 6% odd. That's the broad breakup of the revenue. The geographic mix, currently domestic is around 92 odd percent, with exports of around 8%. Exports expected to double in terms of overall mix in the next few years is what they're targeting. They're targeting a 15% export number very, very quickly. Now let me allow Puneet to start off with the income statement in terms of the metrics.
Well, definitely. It's been a very strong performance by the company over the last 3 to 4 years. From FY22, the revenue has grown at 27% CAGR, and that's passed on to the margins as well. Over 26 to 27% is what they've done in this particular time frame. Profits subsequently have grown at 28%. So this acoustic as well as aesthetic products that they manufacture for automobiles has been working very well, essentially with the premiumization of this particular space, and that's visible in the company's numbers as well. So there's no doubt it is a big thumbs up given on this particular metric. Balance sheet, Harsh.
So equity quite decent in terms of its size, 680 crore, fast growing because it's extremely profitable in the sense it's got a strong profitability. Also, it's trading at around 6 times book value, so something to be taken care of, but very, very low to no borrowing. Your cash bank balance is also decent. There's some capex in the pipeline. We'll speak about that with the management. Cash flow, Puneet.
Well, again, cash flow, we spoke about the profits that subsequently almost doubled in the last 3 years. The cash flow from operations also has gone from 87 crore all the way up to 163 crores in FY25. We've seen the cash flow to profitability or ratio as well on your screen right now doing very well, while net cash flow, while lower, has been lower because of the investments that they've done over the last few years. They've also done roughly about 45 crores of capex. They're expecting to do that in FY26, but that largely seems to be investing for the future. So we've given this a thumbs up as well based on the company's future outlook. as well as the efficiency with investments, which is, showcasing in the numbers as well.
Excellent. Let's talk about return ratios, and you see that above the 20% mark, no questions asked, and therefore a thumbs up. It's a sustainable 20% given that there is some bit of confidence with regard to margins, and if that continues, top line growth, margins, well, no reason why this should not be sustainable. Shareholding, Puneet.
Now, shareholding has largely been stable from the promoter family. We've seen from roughly about March of 24 when they've held 21.8% stake. We've just seen in the previous year that private equity firm Everstone had actually sold roughly 29 to 30% of their shareholding. So you see the promoter holding has actually gone down from 50% to 21%. But that's largely the exit of the private equity investor. Promoter family continues to have confidence in the business. We've also seen subsequently this selling by the PE fund lapped up by foreign investors. Roughly from 5%, they've gone to 17% in terms of their shareholding, while the investors, roughly 1/3, remains with the general public as well. So keeping an eye on these niche businesses has been one of the key aspects of individual investors, and that seems to be visible in the numbers as well.
Street cred, you look at a 12% 1 month return, 60% 6 months, year to date is 21%, and 1 year is 38%. Since November 2021, since listing, it's a 3-bagger for investors. Clearly a thumbs up, no concerns here. Puneet, I'll allow you to take both valuations and coverage.
Well, let's start with street coverage first. It has 8 buy calls and none of them are hold. The other key aspect is that currently out of the 8, we've picked out a few brokerages like JM Financial, Elara, as well as IIFL. These were some of the ones which were very well known to the street as well. All of these have a very positive outlook on the company. Roughly the target price ranging from 1400 all the way up to 1700. For Elara, they've actually raised that post Q1 earnings as well, which was in the end of July. So it is a positive outlook on the company, and you will hear from them as well. In terms of valuation, while there is not so much comparison available in terms of listed players, because the company also mentions that this is a very wide industry. A lot of players do a lot of smaller aspects of the business, but with SJS largely organizing it and getting it under one umbrella, that seems to be one of the company's moats, and currently trading at over 34 to 35 times price to earnings. For FY26, based on the coverage from the analysts, it trades at roughly around 28 to 29 times price to earnings. And while there are much more established players amongst the auto ancillary space that trade at similar valuation, the lack of any one particular company with this kind of segments as well as granularity seems to be why Street is giving this kind of valuation to a company sub 5,000 crores in terms of market cap. But hence we've given this a neutral on that aspect, but it's definitely positive on the growth the company is projecting.
Excellent. Let's therefore stack up all of the rating parameters, and it gives us a very, very healthy 6.5 out of 8 on our KYC ratings. We spoke with Sanjay Thapar, both Puneet and myself, the Group CEO and ED at SJS Enterprises. Listen to that entire conversation. So you've guided for very strong growth. FY26, yes, you've given that guidance of 20%. So I'm trying to understand a slightly more long-term perspective here. For how long can you continue to grow at this kind of clip? Because as your base grows as well, and you're growing at nearly twice the industry, can you continue to clock this 20% kind of growth clip is what I want to understand first off.
Let me put this a little bit in perspective. So the global market for aesthetic decorative products is close to about $4.7 billion. And at SJS, we've historically, over the last 3 years, we have a revenue CAGR of close to 27.2%, which means that we've outperformed the underlying industry by a factor of 2x or more than 2x actually. The industry in the same period has grown just 10.5% if I combine the volumes of 2-wheelers and 4-wheelers put together. So we are quite hopeful that because of the trend of premiumization, our focus on new products and new technologies, which are higher in value and higher in value add, we will continue to grow around the same clip. So that's what my expectation is.
Oh, so would 5 years be the right kind of view or visibility to take in terms of this 20% growth guidance? Can we pencil in that next 5 years at least the 20% growth clip will continue at the very least?
We don't guide in terms of percentages. So what we say is that there is an underlying industry that we will outperform. So our guidance for the current year was that we will be 2x of the industry growth, and we'll continue doing that. So think of us as a high growth, high profit company, which is still tapping the opportunity set globally. So we've positioned ourselves as a global supplier, and we are very excited about the opportunities that lie ahead of us.
Mr. Thapa, very good morning to you. Thanks so much for joining in. It's Puneet this side. We spoke recently post our Q1 earnings as well, and largely you seem to be quite positive with the acquisition of Walter Pack as well as your consumer business as well. Given that you are outperforming the industry, you're roughly at about 760 odd crores for FY25 in terms of revenue. Could we anticipate that this could lead to almost doubling in the next 3 to 4 years, given the new products that you integrated are still to see a bigger impact in your existing businesses? So could that be a fair assumption given the strong margin profile as well?
I think that's a fair assumption. So I'd be disappointed personally if we don't double our sales in that period of time. So yes, directionally you are absolutely right.
And Mr. Thapar, essentially in terms of growth, it's quite obvious that you are outperforming the industry. Just talk a little bit about Walter Pack as well as the consumer business, because your auto business is growing at a fair click, and that's well known. With chrome plasting as well as something that you've spoken about is a very big business, as well as with the export opportunity. Which business do you think will lead the growth for you specifically? Is it these two new verticals that you expect? And what is the expectation of some that you can quantify for the consumer business as well? What can we look at?
Look, the way we look at ourselves in terms of a growth opportunity is through the lens of the customer. So what does the customer want from a global supplier? He wants a company that can offer him the best-in-class products at a cost that is very competitive and with no delivery hiccups. So over the years, we've proven our supply chain capability. I export to more than 220 locations across 22 countries, whether it was COVID, whether it was the container blockage. So we've earned that trust. So that makes us very confident that we are a company who's recognized by marquee OEMs across segments, whether it is automotive, whether it is consumer. So we've grown well, and we have a track record of growing large mega accounts. Coming back to Walter Pack, so I think that is a game changer as far as us. So we've, with that acquisition, created a capability set that we lacked at SGS, both in terms of tooling for complex in-mold form parts, also some specialized know-how in terms of 2K molding, and that is a carrier. Think of it as a force multiplier for SGS, because we have a very strong printing background, printing on different substrates. And with this acquisition, we've actually, what we've done is we've created a very niche set of components. And Walter Pack is one of the very few suppliers, Walter Pack Spain I talk of, is one of the very few suppliers globally in this area of in-mold formed decoration parts. And with this acquisition, I think we are at the forefront in terms of technology. These are expensive parts, but we see the trend of premiumization that happens in India. So typically you launch high-end expensive parts in premium top-end segment of vehicles. Slowly customer demand for such aesthetics percolates down to the mid segment and the entry segment. And we see the market growing very rapidly once that happens. So we are, I think, strategically in a very good position as far as Walter Pack goes, both in terms of technology. This is a long lead item because tooling is very complex. It takes close to about 8-9 months to make a tool. So I would say in the period of 4-5 years, you should see significant contribution coming from the in-mold form parts. We see a lot of demand for chrome plating, especially in the export markets. So we could possibly see a lot of business growth in that area as well. And largely to say, what are the growth drivers? So four-wheelers as a business segment will grow very rapidly for us, as will consumer businesses, thanks to the new technology that we are launching.
Mr. Thapar, on Walter Pack, Q1 was a slightly softer quarter. When do you start to see recovery there? Of course, reasons well known. There's some bit of drag coming in with regard to clients. When do you see a recovery there in terms of your top line? And what does Walter Pack do to your margins? Are you able to maintain that 25-26% kind of margin number?
I think we've proven that. So historically, we've maintained margins north of 25%. So 25-26% is what historically we've delivered. Maybe 3 years or 5 years now, and after the acquisition of Walter Pack as well. So I think the truth lies in the numbers. So Walter Pack is an important component to our overall strategy. Where do we see? So since this was an acquired business, there's a legacy set of customers that we have. So as a company, we de-risk ourselves by saying we should not be too dependent on one single customer. So in fact, consolidated basis, no customer constitutes more than 15% of my top line. But that is not true for these subsidiaries that we have. These are basically acquisitions. So there is a legacy set of customers. So we are fast gaining traction with other customers as well. And I expect that balance of customer concentration should also reduce over time. And we already have good visibility for orders that are coming in. But as I said earlier, Walter Pack parts are large in-mold form parts which require tooling time. So I would imagine that over the next 1 year or so, we should see Walter Pack coming back and it being a more diversified play, reducing the customer concentration that we currently have.
Mr. Thapar, one question on your kit value specifically, because we've spoken about this in the past. You were at somewhere around 1,200 to 1,500 for passenger vehicles. You've now gone to roughly between 4,000 to 5,000 post Walter Pack's acquisition. Now, you've had some huge guidance. You're mentioning that this will double in the next 3 to 4 years. Could you specify if this will be done via new products like cover glass amongst others? Or will this be with increasing your current business with your current clients, the top 7 to 8 that you cater to? So where should the growth come from?
So growth comes from both these areas that you mentioned. So yes, displays continue to be a very strong opportunity set. SGS is well poised to address this market because of our inherent nature of the products that we've done for a number of years. So aesthetic parts, and cover glass is also an aesthetic part that requires printing. And we are in the process of examining what more can we do in the cover glass business. So we don't want to restrict ourselves to cover glass. The overall displays as a category is very interesting for us. And we are positioning ourselves to address that market. The kit value that you mentioned, you're right, from 5,500 odd rupees potentially per four-wheeler. It is likely to go up to 10,000 per vehicle over the next 3 to 4 years. And SGS is, I think, strategically absolutely in the right direction.
And Mr. Thapar, just a follow-up, what would be, the kind of addition that you think that cover glass could do to your products? Is it one of the most game-changing aspects? Because it seems to be that your current products are adding a lot of value, but this one is a high, the price of that per vehicle is also high and the margins are also better. So what kind of addition do you think that could get you?
So my guidance really is that we continue adding new products. So cover glass is one, in-molded electronics is another area that we're working on. So all these are new technologies. At the moment, there's nobody who makes cover glass in India. So as we move forward, I think we will have an early mover advantage, and they will continue to deliver revenues for us. But our revenue growth, even in the other lines of businesses, are very strong. So we have a great opportunity for cross-selling. So every time that I order new customer, I have maybe 40 different product technologies that I can offer to them. So our ramp up is pretty rapid. And every time that we acquire a new customer location, so there's a lot of opportunity for growth. So where the growth will come from will be both. This cover glass business and display related businesses will grow, as will our other product lines that we've created over the past years. So it's a secular growth. But as I said earlier, automotive four-wheelers are likely to drive growth because they're larger products and larger cover glass, larger everything. So both interior and exterior. So that's a great area that we've pivoted to. So maybe 5-6 years ago in 2019, 70% of my sales came from two-wheelers, which we've successfully transformed, and now it's equal weight. So maybe 35-36% from two-wheelers and 35-36% from four-wheelers. So I think I'm quite happy with the way we've been able to pivot the company.
So where does this go in the next 3 years? Do you continue to add product lines and therefore that will not only expand your market share within this segment but also allow you to capture market share in other segments? Is that how one should think of SJS?
Yeah, our products are fairly agnostic to the end use, So typically if you have a treadmill, that requires overlay we make. So those are markets that we've not addressed yet, but growth will come across all segments. So it's hard to call out any one area, but broadly, appliances and four-wheelers will drive growth for us, especially in the export markets. India, of course, we continue to retain our position and consolidate our market position.
Mr. Thapa, just one final question from my side. Essentially for two-wheelers as well, you mentioned that the share has gone down from roughly 70% in 2019. You are adding new clients. You've added Hero in the last couple of quarters. Could you just give us some sense of the competitive intensity in this space? Because it's a high volume product. We're also expecting some kind of cost increases because of ABS. So what does that do for you, for example, in terms of the cost increasing essentially? So what is the current conversation that you're having with clients and who are you actually competing with? Because for the first time you've gotten Hero and Hero sells over 50 lakh motorbikes. So just some sense on that sense as well.
No, so let me correct you. Our two-wheeler business has not come down. It has increased.
The share of course, four-wheelers has also increased. Understood, the overall revenue.
Businesses have grown tremendously, so therefore that weight has come down. So that's the point. Yes, we are very optimistic about Hero, so that's a good addition to our portfolio. And we continue to develop new models for them. And as I've stated earlier, we would potentially look to consolidate and gain a significant market share with that, as is our endeavor with all customers. So coming back to ABS does not impact us really because what we do are PVC films and special materials for their logos. So there is not much of a challenge in terms of ABS because we don't do plain vanilla molding. The business that we are in is high value add decorative products that are long lasting. And that is what is our DNA as a company. And that translates into, it's a very complex business, batch mode operation. So competition intensity is extremely difficult. So there is, I don't know of a single company in India or overseas which has as many products as I have in my portfolio. So we have close to about 14 different technologies, and most of the competitors that we have focus on just one or two. And I think what helps us with that is to position ourselves as the supplier to go to when a designer looks at improving aesthetics in a vehicle. So they're happy to do that. We have a styling studio which designers come and work along with our designers to formulate specs. And we do this pro bono. So we also have rapid prototyping capability. So we supply products with a very short turnaround time, and that I think engages us even more deeply with our customers.
Well, he also spoke about CapEx, and he said that CapEx, which is in the pipeline over the next 2 years, will take their top line from the current sub 800 crore to 1400 crore nearly. So that's broadly the guidance. But, that's all the time we have from Puneet, myself, and everyone who puts this show together. Thanks so much for watching. Hope you found it productive. Of course, stay with us on NDTV Profit.
Tech has changed, so should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Today, it's all about calculations. On the one hand, we're going to talk about how you should pay back your loans. When is it beneficial for you to prepay your loans? And what is the order that you should consider prepaying your loans or getting rid of your loans if you are paying different rates of interest? That is, if you have a personal loan and a home loan or some other type of loan. There are a few strategies that you can employ. And the second part of this conversation is a very interesting calculation which actually might throw up a situation where you can earn more on an EPF in your employee provident fund than you could earn in equity post-tax. I know that it's not a like-to-like comparison, but still it's an interesting calculation to consider and to look at. But first, let's talk about loans. And joining me on the first part of this conversation is Mrin Agarwal, who's a financial educator and founder of FinSafe India. Mrin, thanks so much for taking the time. First up, let me ask you this. From a prudent financial planning perspective, how much loan is okay and how much should your EMI be as a percentage of your take home?
Good evening, Alex, and nice to be here today. Well, from a prudent financial planning perspective, the EMI as a proportion of your take home needs to be limited to 30%. And, the strange thing is that I see a lot of people who are at this 50, 70% of their take home going towards EMIs. That's just too high. You're just living your life in debt. So I think smart way of borrowing is to keep your EMIs limited to 30% of your take home. And this is all your EMIs. It could be a home loan, personal loan, car loan, whatever it is, total EMI does not exceed 30%.
As much as the prudence makes a lot of sense, I think, and a lot of young people, Mrina, are buying into this idea of prudence and they want to live their lives on their own terms. But the old situation was that you start earning, you work towards buying a home. And unfortunately, the reality of it is that places like Mumbai, places like even Bengaluru now, places like Pune, real estate, New Delhi, real estate is getting so much costlier than it was even 5 years back, that buying a home is incredibly difficult. And so the argument that people make is that in the initial years when they're earning slightly less, they can stretch a little bit, and when their earnings go up, then automatically as a percentage of their take home, the percentage goes down. Is that the right approach in your opinion?
Yes and no, because finally I always say that, we can do all these calculations on Excel, but then if you're not happy about it and it's feeling very bad and it's affecting you, then obviously you should do what you want to. But, the issue in doing the stretch is that, you kind of get attuned to living your life on that stretch. And that's what we are seeing today, right? Like we're seeing such a high incidence of loans when you look at the whole household debt, right? So I think the issue, what happens is that you get used to living on that particular stretch and then like bringing it down to the 30% is a little tough. So I would actually say wait it out for some time. And, of course, there's this whole buy versus rent argument that is there to say that why buy at all, just stay on rent. So I would say enjoy your life on rent when you're young, and when you can really afford it, then look at buying that house.
Yeah, it makes a lot of sense, which is not to say that you should never buy. You should absolutely buy, because when you stop earning, that is a security that you will have. But Mrin, absolutely buy into that philosophy. But what if you have a home loan? And this comes to the first calculation that you've shared with me. Can you take me through it? Because you've assumed a loan amount of 80 lakhs, which I think is normal in a city like Mumbai. You can't get away with not taking a large loan. And I'm glad that you've taken a slightly larger loan, because I think a lot more people can relate to this then. The tenure is 20 years and the interest is 8%, which again is a pretty normal amount if you consider the longer term, right? You might be able to get it less right now because the interest rates are lower, but then the average cost will be that much. So how do you work out something like this? What are the strategies that you would employ?
Yeah, so this was more, because I get a lot of questions from people saying that I just received my bonus or I've just got some extra money and should I prepay or should I invest? Because what happens is that, typically one thinks of it like this, that my loan is at 8% and what I can maybe generate from my investments, especially if it is in equities, is going to be between 10 to 12%. So then, the question then remains that why should I prepay the money? Why don't I just go ahead and invest? So we'll take this, I'll give you the answer in two parts. So the first part of it is really in terms of what happens if you do a repayment. So let's say that, in this particular case, you have some extra amount of money and you're prepaying 1 lakh rupees every year, right? So what happens due to that is that you, of course, save a lot on the interest. So versus the 80.5 lakh rupees as interest, you're almost saving around 17.5 lakhs as interest. The bigger aspect is that your loan tenor is falling from 20 years to almost 16 years, right? So you're repaying your loan 4 years earlier, right? So that is if you do the prepayment every year. Now, if you say, no, I don't want to do the prepayment, I want to go ahead and I want to invest this money every month. So, assuming a 12% return, in 20 years, that amount, the 1 lakh rupees invested annually every year will lead you to about 76 lakhs, right? Now, this is where the numbers are concerned. So what you're weighing for yourself is, do I want to prepay my loan 4 years earlier and save on 17 lakhs interest? Or do I want to have 76 lakhs wealth? And, Alex, there's no right or wrong in this. It all depends on your mindset. If you feel that I want to get debt free earlier, then go in for prepaying the debt. If you feel no, I want to create wealth and utilize it for other purposes, and of course you believe that your income will increase and due to that you'll anyway be able to prepay the loan earlier, then go in for that. But yes, you should have this perspective of what you can get on both sides.
It's important that you point that out as well. And for everybody tuning in that's not familiar with this scenario, in a home loan, what happens is that you're better off prepaying in the first half of the home loan, because the way that the EMI is constructed is that in the first half, the interest component of the EMI that you pay every month is much larger, and in the second half, particularly towards the end of the home loan, the only thing that you're paying effectively in that EMI is the principal. And so if you get rid of the principal early, the interest incidence comes down quite dramatically. Now, Mrin, it's important to point out that this is a pretty simple calculation. We haven't even taken into account the fact that a lot of people in the past were also taking advantage of the old tax regime, where they were saying interest cost is deductible from your taxable income, and to that extent they were saving a maximum of 60,000 rupees per individual practically, and if it was a repayment by two individuals, then you could save potentially double of that, right? So we're not taking that into account because I think a lot of people have moved to the new tax regime. Would you agree?
Yes, of course, the calculations did not take into account the tax regime. And the other point that I do want to point out is that at the end of the day, you're still paying the interest, right? So even if you're getting the tax benefit, there is still an interest outgo that is happening.
But then it comes to a few scenarios, right? We've assumed in this first scenario that you will get 12% over the course of the lifetime of the investment, which at this point, it must be said, it makes sense. But then who knows, in 10 years, you might have a lower rate of growth for India and you might have to reset lower. So we're making certain base case assumptions. And of course, interest costs could also, by that argument, go down quite dramatically. It may not stay at 8%. So equally, that is fine. But having said that, there are a few more scenarios that we can build in, right? To say that apart from this home loan, you might have other loans as well. So if you have multiple loans, what kind of strategies would you employ if you're trying to pay them off?
Yeah, so the typical strategy always when people have multiple loans is to always focus on the high interest loans first. So like credit card loans or like personal loans, right? Because you always believe, okay, I'm paying 17%, 40% out here as interest. So let me first get rid of these loans. But I think that strategy works when you have only like high interest loans, and typically most of them are lower tenor in nature. But when you have a combination of loans, so for example, when you have like a personal loan and you have a home loan together, that strategy may not work because, by the very fact that the home loan, the actual absolute outgo that you have every month and for a longer tenor as well, creates a very big impact. So if I can just explain this through an example, that let us say you have a home loan for 50 lakhs at 8% for the next 20 years. And you also have a personal loan for 12% for the next 5 years, right? So the total outgo, the total interest outgo that you're going to have in both the cases is, put together is going to be about 52 lakhs over this 20-year period, right? Now, typically, if somebody has money and they decide that I want to prepay the personal loan first, and of course, everything is assumptions here that we've taken. And, one of the things that I want to call out is that each person really needs to sit down with their financial advisor and work this out for themselves, because there are so many different situations that can happen. And, and it all depends on which is the year that you want to do the repayment as well. But let's say we've assumed over here that the repayment is going to be in year 3. And then from year 4 onwards, you're utilizing that extra amount to repay the home loan, right? So in this case, what happens is that your total interest outgo from 52 lakhs becomes 41 lakhs, right? Now, let us assume that you think that I am going to close the home loan first, right? Because there's a higher amount of outgo. So you're going to close the home loan from the second year onwards. You're going to start paying 2 EMIs. So of course, here what happens is that because you're closing the home loan first, and again, as you explained, that in the first 5 years, it is basically the interest component that is higher than the principal component. So due to that, the total outgo on interest will reduce to about 38 lakhs. So as I said, there could be a lot of permutations. It all depends upon what are the loans that a person has. Ideally, what you need to do is make a list of all of these loans and then work on an Excel to really see what makes sense to basically pay off first. But I would think that when you have high value loans, your focus should actually be on paying off the high amount loans first.
Okay, so that makes sense. Let's talk about a couple more things. One in particular, right? Because in the current juncture, you have the interest rate regime, which is moving to a lower rate regime, right? So the Reserve Bank of India has been cutting interest rates. It is possible that you might have another couple of rate cuts. And a lot of people are assuming that a further 0.5 percentage points or 50 basis points will be shaved off. And that means that home loans will be heading lower, the cost of home loans, interest cost. So therefore, the question arises that in a falling interest rate regime, what should your approach be? Because the two levers that you can use to adjust, Mrin, one is the amount that you pay every month, and the other is the duration or the tenor that you pay. And that is true either when the rates are going up or when the rates are going down, right? So what is beneficial?
So when the interest rates are falling, clearly maintaining the same EMI is good, because what will happen is that the tenor is going to reduce. Since the interest rate has gone down, you're still paying a higher amount. So if you were to recalculate the EMI, then it will be a lower EMI. But you have decided to keep the higher EMI, which means that the tenor is going down. And it also really means that you're going to have a lower amount of interest outgo, and you're also going to close your loan faster. Right. So, of course, in the falling interest rate environment, it does make sense to ensure that you keep the EMI the same and let the tenor reduce. And of course, it's always helpful, irrespective of whether rates are going up or rates are going down, it's always helpful to make part payments, because part payments will always ensure that your interest outgo reduces. And, Alex, I think this is one of the things, right? Like, people don't realize that, even though the interest rate is at 8%, one feels that it's a very low rate and I'm generating a higher return on my investments. But the reality today is that the principal of the loan and the interest outgo is the same. So, for something that's worth 100 rupees, you're actually paying 200 rupees, right? And that's where I think the focus on any loan repayment really needs to be on reducing that absolute number.
Yeah, 100%. I think it's a very important point that you raise. When you're thinking of your returns from investments, you think about how quickly it will double, right? And that simple rule of 72 formula. So in a very simple example, you divide your 72 by the rate of interest that you're earning. So if you're earning 7.2%, then you're doubling in 10 years. This is true when you're paying something as well. So I think you raise a very, very important point. The last point has to do with how to, a few things to get debt-free faster. You want to run through the list?
Yeah, I think taking a loan only if it's necessary. These days you have all sorts of loans. So of course, I would say just try to stick to the home loan. And certainly you don't need early wage access and BNPL and these sort of things. And of course, keep increasing your repayments with the increasing income, and look at, using windfall gains also to repay loans. And of course, keep that whole, this whole aspect of getting debt free should be at top of your mind.
Got it. Absolutely. So, Mrin, thanks so much for this very important conversation. Hopefully, we've got people to look at their finances and drop their own calculations, because ultimately that's what you'll have to do. Thanks so much for taking the time. All right, now let's go to our second calculation, moving from a calculation on loans, which is on expenses, to returns, which is investments. And We're talking about the Employee Provident Fund, which is something that employees have to do. Of course, you can bring it to the minimum, but that's not something that most people talk about what you should do. And joining me now is CA Nitesh Buddhadev, who's a founder of Nimit Consultancy. Thanks so much, Nitesh, for taking the time. I saw this post that you had done on social media, and I thought it was an interesting conversation. Let's get into the scenario building first. What is the thesis that you are presenting?
Thanks a lot. Thanks a lot, Alex, for having me. When I'm looking or analyzing any number, I would like to go behind the headline number. That's exactly what happened when I was researching on the EPF numbers. So my book claim is quite bold when I'm saying that your 8.25% EPF can deliver better return than the 16%, maybe the equity one. Why I'm saying that, Alex? When I'm investing into the EPF, okay, as an employee, now there is two scenarios that either I have opted for EPF or I have opted out of the EPF, and the third scenario is that minimum 1800 of the contribution going from my end and also the employer's end. This is the normal three scenario exists when it comes to EPF. Now many people are just putting 1800, or I have seen many of the prospects which we come across are not putting into the EPF, and that's why the whole research started, that why EPF contribution is something quite relevant for your retirement corpus, considering the debt component and also in the new regime, Alex.
Important, and this is particularly after the shift to the new regime has become much more lucrative, I think, after the latest changes, and the fact that you're not getting ATC anymore, right? So your contributions to the EPF, which fell under that 1.5 lakhs of the ATC in the old tax regime, is no longer available to you, but the contributions that your employer makes is still relevant in that EPF calculation. But why are we looking at, first of all, Employee Provident Fund and comparing it with equity? These are two entirely different things, aren't they, Nitesh?
True, completely, Alex. But I wanted to highlight the benefit of 8.25% interest, because people are just going by the headline number. So, Alex, let me give you a case study, which I, of course, did on the social media, like you rightly mentioned. Let's say there are two colleagues, okay, working in the same organization, having the same basic salary. One has opted for the EPF, other has not opted for the EPF. And let's assume that 1 lakh rupees is the basic salary. So the person who has opted for the EPF, even in the new regime, he will contribute 12,000 rupees, which is 12% of basic. His employer will also contribute 12,000 rupees, 12% of the basic. Now, the Alex, like you rightly mentioned, even though I am in the new regime, the 12,000 contributed by the employer will not form part of the taxable salary. That is how it is adding a lot of value in terms of your return. So the 12,000 contributed by your employer, you have contributed the 12,000 rupees, which means you are investing 24,000 a month. 12,000 contributed by employer and 20,000 yours. 24,000 a month you are contributing. If I see the calculation at 8.25% return after 5 years, the corpus at 8.25% interest is 17.75 lakh rupees. Okay. Now, another scenario, the person who has not opted for EPF, now he will not be able to contribute whole 24,000. I am considering that because the 12,000 benefit which employer might have put into the EPF, now because he has not opted, so his taxable salary would be higher than his colleague, because this 12,000 not contributed by his employer into EPF, his CTC is same, but just because of that 12,000 is tax free for his colleague, for him it would be taxable because he is not contributing to the EPF. Now, because of that, on 12,000, Alex, I'm considering 31.2% tax, because he has to offer tax as per the slab rate. Now, instead of investing 24,000, he would be only able to invest 20,256. His own contribution, I'm considering 12,000. And because his tax is deducted on the other 12,000, which his employer is not contributed, that is total to 20,256 rupees. So now, his friend contributed 24,000 full versus he's just able to contribute 20,256. And I'm assuming that he's investing in equity or maybe a mutual fund. Now, even at 11% CAGR, because I'm assuming in long term 11 to 12% CAGR return one can get on equity. Now, if this 20,256 invested per month for 5 years, the total corpus after 5 years would be 15.75 lakh as against 17.75 lakh rupees in the EPF, Alex.
Post-tax, this 11% is compounded annual post-tax. It amounts to 15.75 and 12%. Therefore, you're talking about approximately 12%, right? 12% is the actual return.
I'm assuming 11% CAGR return. Now, after this 11% CAGR, I also deducted 1,25,000 long-term capital gain, and whatever gain left, I have calculated 12.5% is the tax. After considering all this thing, the corpus in my hand in equity part is 15,75,000.
Okay.
Now, Alex, the claim behind that 8.25% is equal to 16% is why? Because if I want to earn the same return, which is 17.75 lakh rupees in equity or equity mutual fund portfolio in 5 years, I need 16% return. If I get a 16% return after paying taxes, I will have in my hand 17.75 lakh rupees.
Got it.
And that's saying that 8.25 is higher than 16%.
Yeah, that's a very interesting calculation that you've done. And I must also state that while we've taken a 1 lakh basic, and there will be some people out there will scoff and say, oh, you know, that's too high. Ultimately, this argument can be made for a lower salary as well. This is just illustrative in nature. It's to ensure that you understand the numbers behind it. But there are a few more data points that you've added, right? So you've talked about what the CAGR over 10 years would get to, 11% over 15 years. What is that all about?
Right. So, Alex, somebody will argue that I'm not just investing for the 5 years and my equity, I'm going to stay invested for 10 years, 15 years, and 20 years. By the way, I just wanted to highlight the benefit of EPF that many people ignores, or this is especially for someone who is just contributing 1800 or not contributing at all. And that's why I went ahead and also did a calculation for 10, 15 and 20 years break even. So Alex, if somebody wants to achieve the same corpus of 17.75 lakh for 5 years, the break even I told you is 16%. But what if somebody is investing for 10 years? Okay. The break even point is 12.3% return. So if I get a 12.3% return, okay, and this 8.25% in EPF equals. So that's the break even point after 10 years. But if somebody is staying invested for 15 years and equity delivers 11% return, still this 8.25, the corpus you get in the EPF at 8.25 versus this 11% is same. Or even at 20%, Alex, at 20 years, you need 10.35% CAGR in equity to equate with 8.25% in EPF. But all said, I'm not at all saying that your EPF is alone enough for your retirement corpus. But you cannot ignore the equity. At the same time, you should not be ignoring the EPF.
And that's an important point that you raise, especially because people have gravitated towards the NPS. We've spoken about that as well, right? Where because you can have a higher contribution to the NPS, or you can have your employer contribute a certain percentage to the NPS, and that can be tax free. So people are reducing the amount that they contribute to the EPF to that 1800 mark, as you pointed out, and they've gotten their employer to contribute more. Is that a relevant strategy to employ? And I know that that was not the original purpose of this conversation, but people are doing that. Is that something to consider?
Right, because Alex, when I'm doing the EPF part, okay, I would say under the new regime, okay, by the way, this calculus is under the new regime. Yeah. Alex, go to the old regime, it would be even more beneficial. Why? Because in old regime, I can even take the benefit of my own contribution as an employee. So I would definitely recommend that one should maximizing the EPF. But of course, one should also remember, Alex, only up to 2.5 lakh rupees of my own contribution as an employee is tax-free. So over and above whatever I contribute as employee's contribution to EPF, if that crosses 2.5 lakh rupees, that is taxable. But my employer's contribution up to 7.5 lakh rupees is non-taxable. But that 7.5 lakh rupees from employer's contribution includes your EPF, superannuation, and NPS. So one has to balance between what they want to put into the NPS versus what they want to put into the EPF. But I say that only triple E status exempt is only EPF which is available under the new regime, because your contribution when you are doing might be taxable, but you are not getting the benefit, but your employer's contribution is tax-free. Interest you earn up to 2.5 lakh rupees is tax-free. The whole corpus you withdraw at the end of the tenure is also tax-free. And that's why only EEE status is with the EPF.
And of course, we've taken 8.25%. In a lower interest rate scenario, the argument can be made that that will go lower, but it has traditionally been relatively high. So Nitesh, I think the case to retain your investment in EPF is a strong one, and it's certainly something that people should consider. And you've provided the numbers to back it up as well. Thanks so much as always for taking the time.
Thank you so much, Alex, for having me.
All right, that brings us to the end of this edition of Your Money Matters. Tell us what you think, whether the numbers work for you as well, or if you have a different calculation, let us know in the comment section. And do stay tuned. This is NDTV Profit.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time,
Viewers, all eyes are out on what do the additional tariffs mean for India, and I think we're trying to speak to as many global voices to try and understand how do they think about it. Somebody who looks at India very closely is Trin Nguyen. She's senior economist emerging Asia at Natixis, and she's put out a tweet which we would like to highlight before we get to that conversation with her. So if you can just show what Trin is saying. She's saying that for the BRICS places, or the BRICS nations, India is the big demand market. They sell more than they import as they have a surplus. Trump threatening 50% tariff on India makes Modi turn towards Russia and China and BRICS to solve the crisis, but India is the big demand market for BRICS. Now, and therefore, could the pieces be slightly different for the big demand market of the BRICS nations as the 50% tariffs come into effect in the next 24 odd hours? Trin, great having you as always, and because you have such a keen eye out for trade and India and emerging Asia, would love to know how you think about this piece now that US has notified that the 50% tariffs will come into effect within the next 24 hours.
Well, the big picture is the war is not ending by tomorrow. So I think the 50% is here to stay, but they need to go lower, and they will go lower. So at the very minimum, we'll get rid of that 25% to settle at 25%. So the question is not whether, but how we get there and when. In the meantime, what is considered India's Achilles heel, which is limited exports of labor-intensive manufacturing to the rest of the world and to the U.S., is its strength. What that means is that export to the U.S. is only 2% of GDP. The affected, which is removing exemptions such as ICT, pharma, it's only 1.2% of GDP. So assuming that we get a reduction of 50% of that, of 1.2, which is roughly 60 basis points hit to growth, as you mentioned. Now, that's a minor point, which means that for the Indian government to offset that, they will need to do tax cuts. And of course, the Indian banks will need to help the affected sectors. So what that means is that it's not a free lunch. There are costs. So the bond market is digesting this extra issuance that will need to come if they need to offset that. And also the banks also have to consider how are they going to help this affected sectors through interest rate, right? But we think that fundamentally, even if the short term is manageable, the long term is that India wants to change. It wants to grow this labor-intensive manufacturing part. It wants to export more to the world. And to export more to the world, it needs to export to high margin and big markets. That is the US and the EU. BRICS are important, but fundamentally, India imports more than exports. For example, its deficit with China is greater than 100 billion, right? While it has a surplus with the US. It has a trade deficit with every country in Asia except the Philippines. So for India, this diversification into Russia and into other countries is going to be very painstaking, meaning the future is still in developed markets to export more. So I think it will continue to liberalize. So the EU FTA is something that's under negotiation, and it will need to expand more in that market. We got the UK FTA recently. So the road for India is more trade, not less, even if we're looking at 50% of tariffs, and more trade with the US and the EU as well.
Trin, point well made. The only question is we've waited multiple years, 4 years if I'm not mistaken, for that UK deal to take place, and we all know that there's a lot of back and forth in these trade negotiations. So what you're essentially saying is that in the next couple of years to 3 years, there's nothing dramatic that will shift on the external front for India. Is that the right interpretation? Unless something dramatically shifts with negotiations.
Look, the big picture for India is that it's a big domestic demand market, right? But the issue is that people continue to invest in India to access to its demand market. But India also wants to be a growth driver in terms of growing outward, right, to other markets. So I think here the tariffs will impact ambition to do that if it does not mitigate this 50% lower for the US, because that's the biggest export market for India and also currently in the world. So my view is that if it wants to grow this Make India part beyond just servicing India as a market, it will need to lower this tariff. How it does that is going to be a big question, because domestic politics dictate that Modi takes a very hawkish view, but fundamentally, he will need to find a way to lower the tariffs.
Right. Trin, on the side, a way would be needed to lower tariffs, but if you have to talk about the domestic market, you've categorically said it earlier as well that the domestic market is India's prize. Now, how much of a buffer does the domestic demand provide against this direct economic impact of the 50% tariffs that we're talking about in terms of exports? How much will it be able to cover up for?
Well, the affected sectors are labor intensive, right? Which means a lot of jobs will be lost. Obviously, these are jobs that don't pay a lot. So one way to offset that, of course, is what the government's doing is with GST. Well, of course, they can do rate cuts as well, but rate cuts don't filter through to these lower income brackets that depend on labor intensive manufacturing. So fundamentally, there'll be some export supporting packages will need it for the local governments or the central government. What that means is this is not a free lunch to offset, right? There will be costs borne to India. And this is just a short-term cost. The longer-term cost, of course, is job growth that's needed to absorb jobs that are incoming, demand for jobs, which is underemployed at the moment because informal job is most of the jobs, and formalization, even though it's increasing, is only 11%. And we have the largest population in the world growing massively. So demand pressure will be there. So the cost for India is not the short term, but the longer term. And I think that there's only so much the government can do to limit this because you need the middle class to grow. And you can't really grow that if you have job losses.
Twin, so some things are unfathomable. They will be dependent on a lot of moves that the government would make and reciprocal moves that other governments will make. So let's wait for those. For the near term, therefore, do you believe that if the economic growth impact is not so high, and because the Indian government, via both monetary and fiscal policies, so both the RBI and the government are taking steps, and we hear there are more steps in the offing, to counterbalance the impact of tariffs as well as spur middle class demand. If all of those take effect, would the markets perceive that to be a net neutral to tariffs? And would you believe, Trin, that the economic impact too could get negated to an extent by stimuli provided by the Indian government?
Well, it depends on who you look at. The macroeconomic impact may be neutral, right? So you say, well, look, we're looking at 60 basis point hit. We're going to cut GST, and also we're going to perhaps front load rate cuts, targeted support for the sectors. All of this will neutralize GDP growth. But on a sectoral level, obviously, that's not going to be the case, right? Export-oriented sectors, particularly those geared towards the U.S., will feel a significant brunt. And the question is, how much support will they get? There will be some support, but is it going to be total? I highly doubt that. So therefore, I do think that the picture is the big picture. The devil is in the detail, of course. Macroeconomically, not a big deal. However, if you look at the bond market, it's digesting this, right? India was upgraded. So it should enjoy a significant rally from that because real rates are very high. But it's digesting on what the government's going to do if it cuts GST, right? And so that means that there is going to be more issues. So therefore, I think the response in the Indian market is going to be very nuanced, even if the macroeconomic environment is neutralized, so to speak.
It's interesting that you talk about the bond market trend. I think that there are increasingly Indian companies as a result of that review of the rating that are looking overseas for funding as well in the bond space. And I wonder what the appetite is for global investors looking into the Indian bond markets as well. There has been more interest in the recent past, especially in the context of falling yields in the US. Indicatively, they're expected to fall further. What is your opinion on that? Do you think that more flows will come through in the remainder of the year?
Well, I absolutely think that there's a lot of appetite for the Indian market. The thesis for India doesn't change just because there's a 50% tariff. I think it does change if you're exporting to the US and you can't get this level down. And the good news for India and in general is that the share of export companies that invest in India right now to export the US is very small. Indian companies are still domestic oriented because there's still a lot of needs onshore. And so as a result, I don't see that to be a major issue. That being said, here the risk is that if we don't mitigate that, that will limit the opportunity for job growth, particularly for labor-intensive sector. And worse still, we don't really know what Trump's going to do with pharma, right? Pharma is exempted right now. And the thing about the EU FTA is that it includes exemptions for the EU for incoming tariffs. And I think that makes me a bit worried about the fact that India, with this 50%, is not so much that what is being currently affected, but the future of India trade with the US in general and how it's mitigating the fallout from Trump tariffs. So as a result, I do think that fundamentally tariffs will need to go down. So that calculus tells you that while the short-term risks are not so large, if it lingers longer, it can be a big problem. It's a big problem in terms of the Indian government would need to do much more, which means that the rating upgrades can be limited if it continues to have a big fiscal deficit. The banks will have to take a bigger share of the losses of the export-oriented sectors if it wants to mitigate that. So it does fundamentally will have an impact. And as a result, I'm quite optimistic that at the very minimum, we'll get that 25% Russian oil tariff down to get us to about 25% level, which makes it very comparable to Southeast Asia. And maybe we'll get to the 24% level tariff.
Yeah, well, that optimism is what we will end this conversation on, Trin. And, thanks so much for joining us as always. Pleasure speaking with you.
Let's get in Manishi Rai Chaudhary, CEO of Emor Capital Partners. Manishi, welcome to the show. Always a pleasure to speak to you. Hiral on this side. We have now received the notification that it is happening. 9:30 a.m. is the time on the 27th. Not too much of a change that does come in because all of us know what the impact is going to be. The only thing was there was anticipation that the Indian government had a window of 20 to 21 days with regards to negotiations. Nothing has worked so far. How do you expect the markets to react on the basis of this now?
Well, the markets have already had, a flavor of, the kind of, sentiment depression, if I may use that word, could occur. So this has been well telegraphed. So I wouldn't think that the market would react immediately. But what may happen is that, gradually with diminution of India's geopolitical clout, which is quite obvious from what has happened over the past few weeks, there can be second and third order impact on capex, on investments, on several other products that India is exporting. And those things may actually impact corporate revenues and earnings going forward over the next few quarters, maybe not immediately. And the market may actually be quite, sort of adept, or, the market may actually anticipate that going forward. So, the long-winded response but in a nutshell, I would say that one would have to brace for, further underperformance on the part of India. India has already underperformed quite a bit compared to the global emerging markets. And I would think that, at least in the near term, that might continue. The only saving grace might be the large, domestic stimuli that's coming through. We have already seen that both in monetary and fiscal measures. We could see more of that from what we are hearing.
Got it. Manishi, one thing is the economic impact on specific sectors. The other is how much would it impact the markets as well? And my question to you is this underperformance of India relative to the EMs baking some of this in? Because I would guess the problem was twofold. Growth was suffering and the tariff piece didn't work out as we thought. Now, growth is being tackled. Is this discounted enough, or do you reckon it can have a further impact on markets?
When you say growth is being tackled, yes. I mean, there has been monetary and fiscal stimuli being pumped in. We have seen a jumbo rate cut from RBI. RBI has a lot of avenue to cut rates further. The real policy rate of India is about 4%. It's almost never been this high, except for one or two occasions in the past decade. So RBI has a lot of room to cut rates going forward. The government has, in the budget, given an income tax stimulus, a direct tax stimulus over there, and now they're coming up with indirect tax stimuli as well. But what the investors would look forward to before committing more capital is the impact of these on Indian consumption. And that has not come through yet. If you look at urban consumption, if you look at auto sales, for example, they're still heading down. If you look at the commentaries that are coming in from both consumer staples and consumer discretionary markets, they are sounding increasingly cautious. So I think investors would want to have a flavor of the earnings estimates bottoming out and beginning to move up before committing more capital.
You know, that's an important point that you raise. Manishi, the point is, however, and a counter argument to that, and hi, Alex here, is that if you wait too long, you might just have the horse bolt and then you'll be left with a loss of opportunity. In the context that you have major global markets that are running significantly hotter than India, and so there is a valuation gap to that extent, is there a case to say purely on the back of that foreign institutions must look at India with more attention than they have in the recent past?
A simple answer to that, Alex, would be not yet.
Okay.
Yes, the other Asian markets have been hotter than India. We have seen Hong Kong move up 25%. We have seen Korea move up 30%. These markets, despite this huge outperformance, are way cheaper than India. I mean, today, Hong Kong trades at about 11 times price earnings multiples, Korea at about 10 to 10.5 times. Korea's valuation discount to Asia ex-Japan is about 28%. And the long-term average valuation discount, Korea has always traded at a discount, but the long-term average is about 20 to 22%. So it's still below the long-term average. So despite the fact that these North Asian markets have outperformed India massively, investors can still find much cheaper pockets in these markets than they can find in India. And more importantly, many of these markets and many of the sectors within these markets are actually having earnings estimate revision upwards. Just yesterday I published a report on this where I could identify about 11 country sector combinations which are having a consistent earnings estimate upward revision. None of those sectors are from India. Many are from Hong Kong, Korea, China, even a few from the Southeast Asian pockets.
So I think lots to watch out for, and I think the domestic sectors is something, as you mentioned in the beginning as well, that could see some bit of resilience right now, and probably that should be a space one should be watching out for. Thank you, Manishi, so much for joining us on the show.
Clear issues at hand, and I think a good guest, Hiral, to try and understand how to think through some of these. Vinay Jaisingh, CIO and Head Equity of Advisory at ASK Private Wealth, joins us right now on the show. Vinay, always good talking to you. No different today. Thank you for taking the time out. How are you guys thinking of this whole issue, especially from today morning onwards, now that we know that 50% for now seems to be a done deal?
So, a couple of things. First and foremost, very clearly, we knew that, India is not going to break its tie-ups with Russia. And, we can spend a few minutes on discussing why. We think Russian crude is very important for India. But so we were quite clear that, India won't break its tie-ups with Russia. Second, we realized that as tariffs come more and more into the country from US, India has to look, or we as investors have to look a lot more at the home bias part of it, which is as against looking at buying the dollar or buying companies which earn in dollars. A lot more, it's the domestic market we are a lot more robust or positive about. The good things are very clear. The DXY has reacted negatively, which means the dollar is set to get weaker. It has not happened against the Indian currency so far, but it's happened against the European currency. And also the second good thing is the VIX, the Indian VIX is about 11.5 to 12, which is a very good number. Anything below 18 is great. 11 to 12 means the market is not volatile. Even the US market at 14 is not volatile. So we're not sitting with too much of cash on hand. We just tweaking our portfolio to make it a lot more home bias as compared to, looking at a lot more dollar plays, which we would have probably if we thought that the dollar was going stronger. Our firm view is the dollar is going to get weaker because of US-centric issues on their balance sheet, and interest rates would come down in US, and that would lead to even the rupee getting a lot more firmer. So our home bias view is maintained out here.
Vinay, would you consider another aspect where companies are saying that they would probably look at shifting their manufacturing base to countries with lower tariffs as well. If I know it's not something that will be immediately into effect, will take some bit of time. Do you think that consideration would be a good one from corporate India?
So I would put it the other way around. I'll just retweak your question. Our analysts, both in textiles as well as in CDMO or pharmaceutical sector, are looking at companies where there is not one manufacturing base. Let's take an example. Let's say first of the pharmaceutical space. Suppose you're a CDMO and you have operations in India and in UK. Now, if you have operations in UK and UK has a tariff which is being heard by US, you transfer those production as long as it's fungible to India and vice versa. So you will see a lot of these shiftings which may impact a quarter for these pharmaceutical companies, but they'll come back in base. But to put up a factory, it'll take a couple of years or maybe 2 years to stabilize. That's a lot more dangerous. Similarly, in textiles, we are looking at companies which don't have one factory, but probably 3, 4, 5 factories. So whatever you were doing earlier from India, selling it to US, you'll probably sell it from Bangladesh to US. And India's assets, so whatever India produces would go to, let's say, UK. And that's kind of companies which we want to buy, which already have assets or factories across the globe where they can be fungible as well.
So, Vinay, how do you right now advise on portfolios? Try and sit on a bit of hedge, try and make it domestic centric because that's a hedge enough. How does that work? Part one of my question is that. Part two of my question is, should portfolios position themselves for a potential return of FII flows at some point of time in the year if this issue gets resolved? Because when FIs and DIs both compete with each other, the tape really moves swiftly and you don't have the ability to buy.
Again, very, very interesting questions. If I can take your second question first. If you were to turn back the clock by 20 years, the currency was 30 to 35. The currency has moved up by as much as almost 2.5 to 3 times. So even if the market made a 5-time return, the 3 times part of it, the FII did not get back, and which is why, let's say over a decade, the overall FII ownership peaked at about 20% and is now sub 16%. With my previous comment which I made, the DXY is getting weaker because of US-centric issues and the dollar gets weaker versus the rupee. What you may see is what you saw in April, May, June. In April, May, June, you saw a lot of inflows of FI come into the country. And as inflows of FI came into the country, you started seeing a lot more robust market. But in the month of July and first half of August, whatever $4.5 billion which the FI has got into the country, they took back. So now it's a big fat zero. The net FI flow which has come from April 1st. That number, according to me, is certainly going to change, whether it's 3 months, 6 months, or 12 months. India as an economy is doing exceptionally well. The crude environment is relatively weak. The advantage which we get from Russian crude consumption is as much as close to $5.5 or $6 billion in dollars, but it also saves us forex reserves. So forex reserves itself is very, very high. The Indian government has done what it takes to one of the weakest elements India had, which was consumption. They've tried to they've tried to restructure the entire GST. In the last 8 years, this is the first time there's a massive change. You're making it into 2 slabs. You're trying to make products cheaper for the masses, and probably the syntax products may be a little more costlier. So what that means is the inflation levels too would go lower, which already I think the inflation levels are low in the country. Now, keeping that in mind, that means probably real interest levels are high and that can come down as well, which means the cost of capital for India is coming down, which is all a very bullish signal for the Indian markets to do well. Indian earnings is the second part which is missing. But I think what you may see is in India, or the government starts focusing enough on capex, which they've promised. Consumption, they've already given a lever. You've seen the rains come up a little earlier than required, so rural India will start ticking. The question is whether consumption starts moving faster, and I'm hoping the cut in taxes and GST does it. I think India is looking into a very sweet spot, 1 year of almost time correction, and now your earnings last quarter grew by 6, 7, 8%. Can they grow by 10 to 15%, or can you look at stocks which are growing at 15% and make your own portfolio? I would come in that, and I think potentially FIIs would look into that and come into the country. Again, timing, I am not very clear when that would happen. I was hoping that it happens by April, May, June. I've got surprised because of what's happened in the tariff. This negative news has clearly made India the worst performing market in the last 3 months. On the hedge, just at the cost of being a little repetitive, I would play 2 baskets more than 3. The first is the financial and consumption basket. The second basket which I would play is the capex basket, which are cement companies, which are infrastructure pipe companies, tube companies, power companies. I would play that asset class a little bigger. In terms of Make in India, as I said earlier, I would look at those names where there are multiple factories in the country which are having bilateral treaties in those regions with the countries where they are exporting their products, and that could be a win-win situation. But I don't think I'm going to sit on much cash because India has had a time correction in the last 12 months already.
Interesting take, time correction for India. 2 baskets that you're looking at, consumption, BFSI, and the capex theme that Vinay would be playing out. But thank you, Vinay, so much for joining us on the show and sharing your views.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires.
watching The Big Question. I'm Sanjana. Our top focus this evening. Can India's GST bonanza really cushion the blow of an incoming US tariff storm? Now, the backdrop is stark. From tomorrow, a new 50% tariff regime from the United States kicks in, directly hitting India's labor-intensive sectors. Textiles, gems, jewelry, shrimp, carpets and furniture. Together, these industries fuel jobs and export growth, and a squeeze here could mean a deeper strain on India's external trade balance. On the other side of this equation, the government is pushing ahead with a GST cut that could put more money in your hands ahead of the festive season. The hope is that stronger domestic demand, fueled by a GST bonanza, may cushion the shock of shrinking external markets. But will this policy lever be enough to offset the tariff pain, or is India looking at a double-edged challenge of slowing exports and an uncertain global economy? To unpack this, we have with us an eminent panel. Joining us from London, David Morrison, Senior Market Analyst at Trade Nation, who brings the global investor perspective. I also have Saket Dalmia, former president of PhD CCI, with insights into how Indian industry is bracing for impact, and Jayant Krishna, Senior Fellow at the Center for Strategic and International Studies with the Global Trade and Policy Lens. Good evening, gentlemen. Welcome, and welcome back to some of you to NDTV Profit. Let's begin with the broader picture. This tariff threat isn't just about duties. We're talking about the future of India's export competitiveness and economic growth. David, from your global market analysis, how severe is the impact of the new 50% US tariff on India's key export sectors like textiles, gems, jewelry, shrimp? Are we looking at significant shifts in the global trade dynamics because of this?
Potentially, yes. I mean, I don't think there's any chance that the 50% tariff isn't going to come in tomorrow. And it's obviously everyone is going to want to make an effort to try and mitigate that to some degree. And of course, as you're talking about tax reliefs, maybe some kind of domestic stimulus as well, which could help in the short term to sort of alleviate the tariff pressure, because of course, the longer it goes on, the worse the effects, the chances of growing unemployment in those specific sectors in particular, which is a great worry. But I mean, I suppose that the whole aim must be to get the dialogue going once again and to try and get this rate down from the ridiculous punitive 50% down to something a little bit more reasonable or acceptable. And it looks like the rest of the world is having to deal with tariffs of 15% if they're lucky. So, I mean, I think that would be the aim. But it could be a painful period, hopefully not a long, painful period, before India and the US are able to agree to those terms.
All right. So let's zoom into the Indian industry's response and how exporters and manufacturers are preparing for these challenges at the ground level. Saket Dalmia, with these tariffs effectively raising costs for Indian exporters, particularly in labor-intensive sectors, what operational or strategic adjustments are companies making? Are they exploring new markets, cutting costs? Are they pushing for policy support? We're seeing some of that.
So, well said. I think the government is doing a great job to make sure that going forward, such situations can arise in the near future, and how can we protect ourselves. So we are doing several good agreements like EFTA, like Oman FTA, and such kind of initiatives, which is making sure that industries are not reliant on one particular country or economy when they export. So that's a great initiative. But I think in the immediate term, the SMEs and specific sectors are going to be, or rather are drastically hit when it comes to getting new contracts from America. And hopefully some peace will prevail between both the nations, and they are able to absorb some costs and pass on some to at least survive and have the factories running for this interim period. So definitely the blow is hard, and some ground level small immediate term tactics are the only ways to probably continue to work right now. I think from an industry perspective, that is the only thing they can do. And any new markets, new initiatives obviously takes time and a new customer cycle. So I think we'll have to wait for that to pan out. But hopefully, I think both nations are hoping for a quick solution by the governments so that this is not so painful in the long term and the medium term.
All right, and but I think that the issues aren't going to be resolved overnight, and quite literally at that, because at the same time, let's also discuss that the government, the Indian government, is betting big on GST rate cuts to boost domestic consumption. And let's look at how realistic that is in consumption-driven growth that can offset export weaknesses, especially given supply chain and inflationary concerns. The policy dimension matters. How India negotiates, how reform-oriented the trade strategy can be. All of that will determine outcomes over time. Jayant Krishna, from a geopolitical and trade policy standpoint, what avenues does India have to challenge or negotiate these tariffs, and how might India leverage multilateral frameworks or even bilateral talks to reduce this impact?
See, Sanjana, one thing is very clear in today's day and age, countries don't get what they deserve. They get what they negotiate. I mean, that's like a writing on the wall, right? So I think India has no choice but to carry on with the negotiations, because let's look at the kind of products that India exports to the US, right? You know, we export textiles, garments, leather goods, gems and jewelry, plastics, chemicals, oil seeds, fruits, smartphones, pharmaceuticals. You know, none of these products, perhaps with the possible exception of gem and jewelry, have those kind of margins which can offset a 50% effective rate of levy, rate of tariff, from tomorrow. So I think it's going to be very, very difficult. Gems and jewelry, where the margins were a little more, are anyway that sector is not doing well with the advent of lab-grown diamonds, right? So I think it's going to be very, very difficult. Out of almost $80 billion worth of Indian exports to the US, at least half, if not 2/3 of it is likely to be impacted. So whatever we may do, we have to start negotiating. I know things are not as good because some negotiations had to start this week that US has put off indefinitely. But I mean, whatever it takes. But US is too large a country. It is our second largest trading partner. And also, let's not forget, the country where we get our the maximum FDI that India gets is the US. And last several years in a row, it has been like that. So you can't neglect them at all. Domestic stimulus or tax reforms like GST reforms, 4 slabs getting rolled into 2. Those are all good. Those would stimulate some domestic demand. But let's also look at it. It will also result into some loss of revenue by way of GST collection, at the government end, right? So it remains to be seen how cost neutral that reform would be. But surely some demand stimulation would happen. So some volumes which you are getting compromised because of exports slowdown, I think will get compensated by domestic, consumption. But I think we have no alternative but to keep on negotiating and also, try that, how do we, how do we bring logic in the way US looks at India? President Trump has said that we are a tariff king. That's not true, except some of the electrical and some of the food and dairy products and, alcohol and so on and so forth. If you look at the weighted average of all products, that is just about 4%, 4.6% is the average tariff that India levies, right? And almost half the products that US exports to India, the average tariff is less than 5%. So it's not that bad if you keep the food and dairy products outside, and which we have to protect because it's after all the livelihood of a large number of small and marginal farmers and small dairy entrepreneurs and so on and so forth. So I think India has to step up the negotiations and see logic, and the fact, Sanjana, that we have been friends for so long. I mean, we are no ordinary friends, no ordinary, partners. Our partnership is quite strategic, the way, there are mutual dependencies, the way India is a member of Quad, how, US has been wanting a greater market access for its goods in India. We are possibly the best answer to the quest for alternate supply chains, terminating not in China but other parts. India is the front runner there. And also look at our diaspora in the US, Indian diaspora in the US. It is so strong. And of course, we are best placed to address the Chinese economic aggression, which we have been saying. So looking at all this, I think India has to go back on the negotiation table and keep on, step up the dialogue. That's the only alternative to my mind, because exports are going to be hit. And you may say that impact to the GDP growth will get negated by spurt in the domestic demand, but that's not everything. It's a reputational damage, which India will suffer as the exports fall. And US is among the very few major countries with whom we have an export surplus in favor of India. So I think looking at all this, a lot of domestic, business boost efforts like GST tax reforms are good, undoubtedly. But I think we have to go back on the negotiation table and see that the logic and sanity and rationality prevails on the negotiation table on tariff issues with the US, Sanjana.
All right. Okay, and I think that the reasons that you listed is and how attractive India is also perhaps the reason why Donald Trump thinks that maybe this is a good negotiating tactic to constantly kind of up the ante. But, beyond immediate action, let's look at some structural reforms that India should prioritize to enhance export resilience, be it in logistics, product standards, diversification to higher value goods. David Morrison, what key indicators should investors be watching in the coming months to gauge the tariff fallout and recovery potential?
Well, yes. I mean, that's a very big question, isn't it? To my mind, it's been very interesting how the importance of tariffs and the market effects on the market of tariffs have really dropped out of investors' consciousness really over the summer months. Certainly, July, August, we've seen, of course, the delay on the Chinese tariffs of an extra 90 days. There's a lot to do with that. But really, as tariffs have sort of very, very slowly trickled through into the markets, and bear in mind that sort of the reciprocal tariffs that President Trump was threatening back at the beginning of April, it has been a question. So that these have been watered down repeatedly. Tariff deadlines have been pushed forward, and so I would say that we haven't really seen the full effects of tariffs, but it's going to show up, I think, in the US data. There's still very much an expectation that tariffs will push up US inflation. And because, I mean, who is paying these tariffs ultimately? Well, it's going to be the US importer, manufacturer, and ultimately the consumer who will. Those are costs to individuals in the US. So we want to keep an eye on inflation. So far, it has been tame, but it is US inflation is still a long, long way above the 2% Fed target, and it isn't going in the right direction at the moment. So that's sort of something to watch. And I just wonder whether, if we start looking at stock markets, there are a few things now that the market is getting concerned as we sort of come back to towards the last quarter of the year. And we're going to be looking certainly at US jobless numbers just as much as I think Indian ones, as a sign of whether we are in a situation where we consider sort of what President Trump is doing in terms of undermining the independence of the Federal Reserve, putting the tariffs on top of that. I do think the tariff situation is a bit of a mess, and I just wonder whether we should be preparing for a bit of a fallout as we go, as we head into the year end, as far as equity markets may be concerned, and maybe we'll see, although sort of the bond market is the yields are down a long way at the moment from where they were sort of a few weeks ago. We'll just have to keep an eye on those as well and see if the market is taking any signs of strain. At the moment, the one to watch, of course, is the US dollar, which has come under renewed selling pressure.
Absolutely. I'm going to discuss the currency with you as well, David. But, Saket, David highlighting that while the full impact of tariffs is yet to be felt, the potential inflationary pressures in the US could translate into challenges for Indian exporters. From the industry's perspective, how prepared are exporters for this delayed but possibly significant shock? And what immediate steps are they taking to mitigate these risks?
I think the Indian industry at large is very well prepared. I think in a competitive world where we are very connected to the entire supply chain of the world, may it be small, medium, or micro, We are very versatile as Indian exporters, and they are continuously trying to expand their markets irrespective of this tariff which is coming on board right now on us. I think for the last 6 months, this fear has been on everybody's mind, and the industry is responding to it, is expanding, and I think soon enough they will find some alternate market in the world, and that could also be the Indian market to expand their business to survive this onslaught. Definitely, the Indian industry is of age, and they will survive and grow. This is my personal feeling. Yes, some part of the industry which are very, very small would have a tough time, and there could be some people who would have to perish because they are heavily reliant on one market, one customer. But overall, I think every industry, irrespective of the impact which it has on that industry, immediately will survive and thrive.
All right. Okay. So then, in that scenario, if you're saying that Indian industry is proactively expanding and exploring alternative markets, that's something that we've seen to counter this kind of tariff impact. From a trade policy standpoint, then, Jayant Krishna, how can the government support and accelerate this market diversification? I think we're already seeing it, right? We're already seeing a multi-pronged approach when it comes to India and diversifying that, with or without whether these relationships with the US are strained or not. Are there any diplomatic or trade tools for India that we should be leveraging a little more aggressively to open up new avenues for exporters?
So absolutely, Sanjana. I mean, we are not, sitting idle and thinking that US things tariff issues will get resolved amicably. And the process did not start in January this year when President Trump came to power. It started much before that. Our FTA equivalent with Australia, is more or less, in shape. Only some final, deal points are to be settled. If you look at, we have a FTA with the United Kingdom. We have an FTA with United Arab Emirates. With European Union, we are fast tracking the negotiation on FTA. Even countries like Canada with the trade-off regime, we are talking about FTA, Oman, and there are multiple things. So we are getting into trade deals and major FTAs with significant countries. And let's look at European Union as and when it happens. This is the second largest market for India, right? So I think we are not sitting idle. We are working elsewhere. And let me tell you, while some exports may suffer if this 50% remains, but I'm an optimist. I believe sooner or later, President Trump would see the lack of logic in having 50% tariff on Indian goods. At a time when he has settled for 15% with European Union, with countries like Indonesia, Malaysia, Philippines, just 19%, UK and Japan, 10%, Sri Lanka, Vietnam, Taiwan, 20%. So he would eventually see, and even countries like China, the reason he has given, we are importing crude oil from Russia, right? I mean, very clearly, China imports much more crude oil than what India does. And yet the tariff for China is not as ugly as 50%. So I think, sooner or later, US and some, wise people in President Trump's office and in the tariff negotiation team will see logic in what India has been seeing, and also realize that, we are not denying access to our markets when it comes to food and dairy products. It is just that the kind of people who need to be supported, they're very vulnerable, right? They can't meet both ends that easily. So if any major concessions, some marginal concessions are possible, but any major concession on that front will be like a nail in their coffin, right? So I think India can't take that risk at all, and sooner or later, US will see logic, and the tariff will become less than 25%. I'm very, very hopeful. I'm even hopeful of making it being in line with around 15%. But let that process start. And Indian industry has a lot of resilience. Sure. And when people have to survive, if one door closes, many other windows get opened, windows of opportunity. I'm very sure about it, Sanjana.
That's reassuring, and like you're rightly saying, one can only hope that the US eventually sees that logic, and I think they kind of do. But like I've been saying, I think it is part of the tactic. David, let's change gears for a minute now and look at the GST reforms in India. Do you think that could influence foreign investor sentiment positively enough to offset negative tariff impacts on India's markets?
Yes, but I can't help thinking it can only be a temporary measure. I mean, I keep on thinking back to sort of the kind of stimulus we saw in the UK during COVID, for instance, and the lockdowns that came as a result of the pandemic. And it's still something we are having to deal with now in much the way that during the financial crisis of 2008-9, we're still dealing with the hangover from that. So, I mean, I feel that it is a great measure, wonderful, but I just wonder how much you'd really want to sort of run something like that. And I do think, as we've been talking here, that the real thing must be to sort of get these talks back on track and get something more reasonable from President Trump and his administration. And I do rather fear that sort of the whole business with Russia and Ukraine is playing into this in a big way as far as President Trump is concerned, which is probably, without doubt, sort of making trade discussions so tricky at the moment, I think, for India. That is what my take on it. So, I mean, it just comes back to the fact I wonder whether what the country is doing at the moment is excellent, and any sort of stimulus and help it can give to people is superb. But ultimately, the aim must be to get a sensible tariff deal. As you say, in line with, say, us in the UK or with Europe. Worst case, 10 to 15%. I think that really has to be the aim, if that's at all achievable.
Sure. Saket, are businesses recalibrating their strategies to capitalize on the GST-driven consumption boosts, especially since we're going into the festive season?
I think it's a big game changer. I think the government has hit a 6 out of the stadium on this one. If you ask me, when GST came in 7, 8 years ago, I think we were trying to capture the economy into a formal one. And I think by this rationalization and reduction in GST, the government is recognizing that a large part of that is over and wants to give more money in the hands of the consumer to spend. And this will really, I think, help the customer as well as the manufacturer in investing more. At more certainty, the government is coming in again and again asking us as an industry body to motivate our industry people to invest more into the economy for capacity building. With this kind of rationalization, definitely there is going to be an uptake in demand. There is going to be an increase in investment by industry across the nation and across all products. And I think it will largely give a big boost to the economy, which was having signs of a slight slowdown in the last since the last elections. So I think we needed a game changer, and this could well be that.
Okay. So, Jayant Krishna, final thoughts. Considering India's dual challenge of external tariffs and the domestic tax reforms, how can now India ensure that the GST policy complements trade strategies to strengthen our overall economic resilience, especially in volatile times like this?
So, Sanjana, I mean, these GST reforms were long overdue anyway. I mean, we had 4 slabs of 5%, 12%, 18%, and 28%.
Sure.
Those are being, channeled to 2 slabs of 5% and 18%. And the way it is being done, 99% of goods in 12% slab will transition to 5%. and almost 90% of goods currently in 28% slab will transition to 18%. So some of the product categories where there'll be a huge stimulus in domestic demand, are two-wheelers, small cars, commercial vehicles, where cement, air conditioners, where the tariff will change from 28% to 18%. A lot of food and essential commodity items, which will transition from 12% to 5%. I think so. A lot of FMCG goods, if you look at, they will transition from 12% to 5%. So I think there'll be a huge stimuli insofar as the demand creation is concerned. And only one category perhaps still being talked about as demerit goods or sin goods would remain, and there'll not be many products there of 5 to 7% like tobacco, gutkhas, online gaming, pan masalas, they'll be there, and as expected, petrol and alcohol, it will be kept outside the purview of GST, which is the case even now. So I think this volume wise and impact on GDP wise, I see GST reforms itself will be able to more than offset what will be the loss because of fall in Indian exports to the US. I'm very, very clear about it. But, Indian economy has to grow. If we have to become a developed country by 2047 or earlier, I think we have to grow at 8.5 or 9% per annum. And therefore, we'll have both. We'll have a stimulus for in domestic demand, as well as, we'll bring the trade ties back to normal as soon as possible. I'm very optimistic, and I see that happening sooner or later.
Right, that's reassuring. Jayant, Krishna, David and Saket, thank you so much for joining me this evening. As always, very insightful and a very, very interesting discussion as we are on the cusp of these tariffs. As we've heard tonight, the challenge posed by rising tariffs is multifaceted, touching global trade dynamics, domestic industry resilience and strategic policy maneuvering. While the GST bonanza offers hope to fuel domestic consumption, experts, like we heard this evening, are warning that it's not a silver bullet to offset the tariff shock fully. Navigating this will require coordinated action across government, industry and diplomatic fronts. A big thank you to our panel, David Morrison, Saket Dalmia and Jayant Krishna, for sharing their valuable insights. And thank you for joining us once again on NDTV Profit. This is The Big Question.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of
welcome viewers. You're watching Market Express and I'm your host Himakshi Bahugna, and firstly wishing you all a very happy Ganesh Chaturthi. Now let's just get started with the show. Let's see how the markets have fared today. So Indian markets slumped in trade today as Trump's tariffs on India dragged down overall sentiment. Nifty and Sensex also dropped substantially to end near their intraday lows. The Nifty lost over 250 points to end below its long maintained support level of 24,800 levels. The 30-pack Sensex also saw cuts of around 820 points to wrap up the trading below 81,000. Now, which is less than 1/4 of the listed counters ended in the favor of the bulls. Broader markets traded under a lot of pressure. The mid and small cap indices ended almost 1.5 to 2% lower. Reliance, Bharti Airtel and L&T were the biggest draggers on the Nifty, while HUL and ITC collectively uplifted the index by over 20 points. Now on the sectoral front, Defence, Realty and PSU Bank were the top laggards. FMCG was the only sector in the green today, and on the back of expectations that consumption would actually improve. An early festive season is also expected as the government eases interest rates and also cuts the GST. Although the market momentum dragged the Nifty FMCG index lower, it still ended the day about a percentage point in the green. HDFC Bank shares trade ex-bonus today ahead of the record date. Shareholders to get one bonus share for every share held. Record date falls on a public holiday, so price adjusted today. Bonus aims to reward investors and improve stock liquidity. Karur Vaishya Bank is back in the bonus spotlight with its first issue since 2018. The bank has announced a 1:5 bonus ratio, meaning shareholders will receive one bonus share for every 5 shares held. Now, this move is aimed at rewarding long-term investors, improving the liquidity in the counter and also encouraging more retail participation. So the announcement was made on 24th of July 2025, marking a strategic step to widen the shareholder base and also enhance the trading volumes. Protean eGov wins a 1,160 crore order from UIDAI to actually run the Aadhaar Kendra across 188 districts for 6 years. So the project includes enrollment updates and walk-in services. This also comes in after losing the PAN 2.0 contract despite handling PAN 1.0. FY25 sees a dip in the revenue, margins and profit. MK says the anticipated GST rate cut is delaying the auto conversions, but demand may surge 10 to 20% in Q3 or Q4 due to a nearly 7.5% on-road price drop. So dealers can claim ITC's later easing inventory concerns. However, high stock levels may dampen festive stocking, and also the cess treatment remains a key watch point. RBL Bank plans to raise up to 3,500 crore rupees through a QIP. It also seeks to borrow up to 3,000 crore rupees in debt. The board will discuss these proposals on August of 29. Now, this follows the expiry of prior approvals from August 2024. Bank of America has downgraded Sun Pharma's rating from neutral to underperform, cutting its target price from 1,730 rupees to 1,570 rupees. Now, the brokerage cites concerns over the company's specialty business, including execution risk for new launches. Now, also, the premium valuations are at risk, and the ongoing issues with its largest specialty drug, Ilumya, remain an overhang. India's stock market is pricey but justified by high returns and strong growth potential. A robust regulatory system lowers perceived risk. However, short-term slow growth and declining returns are concerns. India remains the costliest among emerging markets. Here's a look at stock calls on different sectors by Jefferies. So the oil marketing company space first. BPCL stock fell 10% but has a solid earnings outlook. It also trades at similar valuations to HPCL despite entering a high spend phase. HPCL faces higher risk from new projects and potential tax hikes. Jefferies also prefers BPCL for its strong earnings and attractive price. Now to Jefferies on the auto sector. So auto registration rose in August with tractors up 32% and two-wheelers or trucks up 6 to 7%. Passenger vehicle sales also stayed weak, growing just 1%. Buyers are delaying purchases, expecting a GST cut to boost the demand. Jefferies favors M&M and TVS with Maruti and Eicher as next picks. Now let's move to Nomura's take on India's cement industry. The brokerage house says the industry is set for higher prices, a potential GST cut and brand upgrades by mid-tier players are also driving the price increases. West Bengal announced a hike of 11 rupees per bag, and the smaller players also struggle to hold the market share. CLSA strongly backs Avenue Supermarts, predicting a 36% stock rise. DMart leads in customer ratings and engagement. Low prices and wide product range drive its success. It excels in review quality and volume across metro and small towns. Morgan Stanley keeps an equal weight rating on Aavas Financiers. The target price is cut to 1,750 rupees from 1,860 rupees. Loan growth forecasts for 2026 to 28 are lower to 16%. Slower growth leads to reduced returns and valuations. Morgan Stanley boosts target prices for HDFC Life and SBI Life. HDFC Life's target rises to 890 rupees, SBI Life's to 2,250 rupees. Now both maintain overweight ratings. ICICI Lombard's target increases to 1,910 rupees with an equal weight rating. Morgan Stanley raises HDFC AMC's target price to 5,415 rupees from 4,910 rupees. The equal weight rating remains unchanged. Asset under management forecast for 2026 to 28 are increased by 1%. The outlook reflects steady growth expectations. Morgan Stanley raises AB Capital's target price to 330 rupees from 320 rupees. The overweight rating stays unchanged. Earnings forecast for 2027 to 28 are up due to lower provisions in the NBFC business. Higher revenues and lower costs boost the HFC business outlook. BofA retains an underperform rating on Siemens, raising the target price to 2,800 rupees from 2,564 rupees. So BofA views that one round of earnings cut is done, but anticipates another due to ongoing challenges. The brokerage sees the smart infrastructure segment as overly optimistic by the street, while the digital industry segment suffers from weak private capital expenditure. Despite the valuations near long-term averages, earnings are expected to disappoint, largely due to execution issues and sluggish demand. BofA projects limited growth with an earnings CAGR of just 10% over FY25 to 27. This is amid the margin pressures and also the macro uncertainties. Bernstein initiated coverage on Titan Company with an outperform rating and a target price of 4,200 rupees. Titan, originally a watchmaker, has expanded into jewelry and also aims to become a global lifestyle brand. Bernstein notes the jewelry market is evolving formal contemporary styles amid the growing competition. Despite this, Titan has under-leveraged growth opportunities. A key long-term risk is the rising share of the natural diamond and lab-grown diamond dynamics, which could hurt margins on studded jewelry sales. However, Bernstein expects the near-term 1 to 2 year impact to be muted, with growth driven by product innovation and brand strength. Prime Minister Narendra Modi has inaugurated Maruti Suzuki's production line for the e-Vitara, a battery electric vehicle to be exported to 100 countries. He also launched the TDS lithium-ion battery plant, a joint venture between Toshiba, Denso and Suzuki. So the plant will manufacture lithium-ion battery cells and electrodes for hybrid EVs. PM Modi also hailed the occasion as a significant step towards India's self-reliance and green mobility goals. Blue Smart, the electric vehicle startup, is facing insolvency proceedings. Nearly 200 applicants, including Catalyst, Trusteeship and IREDA, have staked claims worth over 500 crore rupees for Blue Smart's assets. The company's co-founder Puneet Goyal and former executives have also filed claims. Bids for settling these claims are likely to be invited in 4 weeks. The Association of Healthcare Providers of India has reached out to the Insurance Regulatory and Development Authority of India to address several issues faced by its members. However, AHPI is currently waiting for IRDAI chairperson Ajay Seth to formally take charge before actively engaging with the regulator. AHPI plans to approach the Competition Commission of India shortly and host a summit on September 13 to discuss the ongoing concerns with insurance companies and regulators. Gamescraft has announced it won't challenge the recently enacted online gaming bill. The company has stopped all real money gaming services and cleared regulatory dues. Gamescraft is also committed to operating within the law and has initiated internal discussions to explore new opportunities. Now, this move comes after the government has passed the Promotion and Regulation of Online Gaming Bill 2025, which bans all forms of real money online games. Bihar has launched a new scheme to promote entrepreneurs' HIP among specially abled persons. Now, under this initiative, the state government will provide a 5 lakh interest-free loan and a 5 lakh subsidy. Now, this move aims to empower individuals with disabilities and enable them to start their own businesses. Mercedes-Benz Pensions Trust has sold its entire 3.8% stake in Nissan Motor for approximately $325 million, marking a complete exit from the Japanese automaker. The shares were sold at around 341 yen each, about 6% below the previous close, which led to a drop in Nissan's stock price by around 6% on the Tokyo Stock Exchange. So Mercedes-Benz stated that the stake was part of pension assets since 2016 and not strategically important, describing the sale as portfolio streamlining. Nissan is also undergoing restructuring amid tariff pressures and intense industry competition, with efforts to restore profitability underway. Apple is set to launch its 4th retail store in India, and it's coming to Pune. Located at Kopa Mall in Koregaon Park, the store will open its doors on September 4. This marks Apple's 2nd store in Maharashtra, following one in Mumbai. The new store will offer customers a chance to experience Apple's latest products and services, including the upcoming iPhone 17 series, which is expected to be unveiled on September 9. Ola Electric has received the production-linked incentive certification for its Gen 3 scooter portfolio. Now, this certification is expected to boost the company's profitability from Q2 of FY26 onwards. The PLI scheme aims to incentivize domestic manufacturing and increase India's share in global supply chains. Elon Musk's XAI filed a lawsuit against Apple and OpenAI in U.S. federal court in Texas, accusing them of conspiring to stifle AI competition through monopolistic practices. Now, the suit claims Apple's partnership with OpenAI, embedding ChatGPT into its operating systems, unfairly excludes XAI's Grok app from App Store rankings despite high user ratings. XAI seeks billions in damages, arguing the duo locks up the market. OpenAI dismissed the action as harassment, while Apple offered no immediate comment. Musk amplified the claims on social media. Experts note that Apple's smartphone dominance bolsters the case, but it may also be seen as a business tie-up. The litigation could actually set precedent for an antitrust battle. The Enforcement Directorate conducted raids at the residence of AAP leader and former Delhi Health Minister Saurabh Bharadwaj and 12 other locations in connection with 5,590 crore alleged hospital construction scam. The investigation focuses on financial irregularities, cost overruns and delays in 24 hospital projects sanctioned during the AAP government's tenure. Despite spending 800 crore rupees, the flagship ICU hospital project is only half complete. AAP leaders claim that the case is politically motivated, while the BJP alleges widespread corruption during the AAP rule. The case originated from an ACB complaint filed in August 2024. The Supreme Court of India formed a special investigation team to probe complaints against Vantara, a zoological rescue center in Jamnagar, Gujarat, conceptualized by Anant Ambani, hearing petitions by advocate Jaya Sukhin alleging illegal animal acquisitions from India and abroad, mistreatment, financial irregularities and money laundering. A bench of Justices Pankaj Mittal and P.B. Varale ordered an independent inquiry. The SIT is chaired by former Supreme Court Judge Justice J. Chelameswar, includes former Chief Justice Raghavendra Chauhan, ex-Mumbai Police Commissioner Hemant Nagrale and IRS officer Anish Gupta. Heavy rainfall has triggered landslides and mudslides in parts of Jammu, causing several roads to close. In Doda, which remains one of the most severely affected areas, a girl died after a house collapsed in Bhalesa. Almost all the rivers and streams are flowing above or close to the danger mark, submerging a number of low-lying areas and roads. President Trump has fired Federal Reserve Governor Eliza Cook, citing alleged mortgage fraud. Trump's letter on Truth Social claims Cook falsified loan applications in 2021. Cook, the first black woman on the Fed's board, denies the acquisitions and vows to fight the dismissal, calling it unlawful. Critics warn this threatens the Fed's independence. US President Donald Trump has announced that American universities will admit 6 lakh Chinese students. Now, this comes despite his administration's earlier visa policy to aggressively revoke visas for Chinese nationals. Now, the move has sparked criticism from his own supporters, with some calling Chinese students CCP spies and a threat to US opportunities. The American president, however, warned Beijing to ensure Washington access to rare earth magnets or face 200% tariffs. But he assured that trade tensions between the world's two largest economies will not affect Chinese students and they would still be allowed to study in the US. Chinese President Xi Jinping will gather more than 20 world leaders at the Regional Security Forum in China next week in a powerful show of global South solidarity in the age of Donald Trump, while also helping sanctions hit Russia pull off another diplomatic coup. Aside from Russian President Vladimir Putin, leaders from Central Asia, the Middle East, South Asia and Southeast Asia have been invited to the Shanghai Cooperation Organization Summit, that is the SCO Summit. So this will be held in the northern port city of Tianjin from August 31 to September 1st. Liverpool 16-year-old prodigy Rio Numoha made history on Monday, scoring a dramatic 100th minute winner in a 3-2 Premier League victory over Newcastle United. At 16 years and 361 days, he became Liverpool's youngest ever goal scorer and the 4th youngest in Premier League history, just 1 day older than Wayne Rooney's record. So the Nigerian-born star subbed on the 96th minute, sealed the Reds' perfect start, leaving St. James Park stunned. Indian shuttler Lakshya Sen faced a heartbreaking first-round exit at the BWF World Championships in Paris. The 24-year-old lost in straight games to world number 1 Shi Yuqi of China in a 54-minute battle at the Adidas Arena. So, despite a spirited fight and the long rallies, Lakshya Sen could not win. This marks another setback for the 2021 bronze medalist, with India's hopes now resting on PV Sindhu and HS Pranoy. Indian weightlifting star Mirabai Chanu made a sensational comeback, clinching gold in the women's 48 kg category at the Commonwealth Weightlifting Championships in Ahmedabad. The Tokyo Olympic silver medalist lifted 193 kilograms to 84 kilograms snatch and 109 kg clean and jerk, setting new Commonwealth records. Despite injury setbacks, Chanu's triumph secures a spot in the 2026 Glasgow Commonwealth Games. India's Chanabam Rishikanta Singh also won gold in the men's 60 kg, lifting 271 kilograms. Chaos erupted at the US Open as photographers sparked a 7-minute delay during Daniil Medvedev's loss to Benjamin Bonzi. Akar, who entered the court at match point, claims he was instructed by a security official and now calls the backlash a lynching, saying, "I'm a victim and totally innocent." The USTA revoked his credentials and Akar is seeking legal advice. Medvedev, who raged at the umpire's call, faces a potential fine. Well, with that, viewers, it's a wrap on this edition of Market Express, but please don't go anywhere. And once again, wishing you all a very happy Ganesh Chaturthi from the team of NDTV Profit.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses for real stories, raw conversation, resilient legacies.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
Let's get in Manishi Rai Chaudhary, CEO of Emor Capital Partners. Manishi, welcome to the show. Always a pleasure to speak to you. Hiral on this side. We have now received the notification that it is happening. 9:30 a.m. is the time on the 27th. Not too much of a change that does come in because all of us know what the impact is going to be. The only thing was there was anticipation that the Indian government had a window of 20 to 21 days with regards to negotiations. Nothing has worked so far. How do you expect the markets to react on the basis of this now?
Well, the markets have already had, a flavor of, the kind of, sentiment depression, if I may use that word, could occur. So this has been well telegraphed. So I wouldn't think that the market would react immediately. But what may happen is that, gradually with diminution of India's geopolitical clout, which is quite obvious from what has happened over the past few weeks, there can be second and third order impact on capex, on investments, on several other products that India is exporting. And those things may actually impact corporate revenues and earnings going forward over the next few quarters, maybe not immediately. And the market may actually be quite, sort of adept, or the market may actually anticipate that going forward. So, the long-winded response but in a nutshell, I would say that one would have to brace for, further underperformance on the part of India. India has already underperformed quite a bit compared to the global emerging markets. And I would think that, at least in the near term, that might continue. The only saving grace might be the large, domestic stimuli that's coming through. We have already seen that in both monetary and fiscal measures. We could see more of that from what we are hearing.
Got it. Manishi, one thing is the economic impact on specific sectors. The other is how much would it impact the markets as well? And my question to you is this underperformance of India relative to the EMs baking some of this in? Because I would guess the problem was twofold. Growth was suffering and the tariff piece didn't work out as we thought. Now, growth is being tackled. Is this discounted enough, or do you reckon it can have a further impact on markets?
When you say growth is being tackled, yes. I mean, there has been monetary and fiscal stimuli being pumped in. We have seen a jumbo rate cut from RBI. RBI has a lot of avenue to cut rates further. The real policy rate of India is about 4%. It's almost never been this high, except for one or two occasions in the past decade. So RBI has a lot of room to cut rates going forward. The government has, in the budget, given a income tax stimulus, a direct tax stimulus over there, and now they're coming up with indirect tax stimuli as well. But what the investors would look forward to before committing more capital is the impact of these on Indian consumption, and that has not come through yet. If you look at urban consumption, if you look at auto sales, for example, they're still heading down. If you look at the commentaries that are coming in from both consumer staples and consumer discretionary markets, they are sounding increasingly cautious. So I think investors would want to have a flavor of the earnings estimates bottoming out and beginning to move up before committing more capital.
That's an important point that you raised. Manishi, the point is, however, and a counter argument to that, and hi, Alex here, is that if you wait too long, you might just have the horse bolt and then you'll be left with a loss of opportunity. In the context that you have major global markets that are running significantly hotter than India, and so there is a valuation gap to that extent, is there a case to say purely on the back of that foreign institutions must look at India with more attention than they have in the recent past?
A simple answer to that, Alex, would be not yet.
Okay.
Yes, the other Asian markets have been hotter than India. We have seen Hong Kong move up 25%. We have seen Korea move up 30%. These markets, despite this huge outperformance, are way cheaper than India. I mean, today, Hong Kong trades at about 11 times price earnings multiple, Korea at about 10 to 10.5 times. Korea's valuation discount to Asia ex-Japan is about 28%. And the long-term average valuation discount, Korea has always traded at a discount, but the long-term average is about 20 to 22%. So it's still below the long-term average. So despite the fact that these North Asian markets have outperformed India massively, investors can still find much cheaper pockets in these markets than they can find in India. And more importantly, many of these markets and many of the sectors within these markets are actually having earnings estimate revision upwards. Just yesterday I published a report on this where I could identify about 11 country sector combinations which are having a consistent earnings estimate upward revision. None of those sectors are from India. many are from Hong Kong, Korea, China, even if you're from the Southeast Asian pocket.
Tech has changed. So should your tech show.
They're the force behind some of India's most respected business empires. But you've rarely heard them speak. Now, for the first time, these leaders open up on succession, conflict, governance, and inheritance. Join me as we step inside boardrooms and living rooms of India's most enduring family businesses.
The Commerce Ministry, along with select key economic ministries, meet officials at the Prime Minister's office to deliberate on the implications of the additional 25% tariffs imposed by the US on Indian goods, which take effect from 9:30 a.m. tomorrow. Dalal Street ends lower as US trade tensions weigh on Indian indices. Both the benchmarks close 1% lower. All sectoral indices except FMCG end in the red. Mid and small cap indices underperform. Rakesh Gangwal Group is set to sell 12.1 million shares or 3.1% equity. Sources say the offer size is worth over 7,000 crore rupees with a price of more than 5,800 rupees per share.
आज से भारत में बने इलेक्ट्रिक व्हीकल्स 100 देशों को एक्सपोर्ट किए जाएंगे.
And Prime Minister Modi flags off Maruti Suzuki's first electric Grand Vitara in Gujarat, set to be exported to over 100 countries. He also inaugurated a new lithium-ion battery plant set up by Suzuki, Toshiba and Denso. Vijay sales banks on GST rate cuts this festive season. Director Vijay Gupta projects sales growth of 15 to 20% over last year. NDTV Profit exclusive. Nearly 200 applicants take claim of 500 crore rupees on Blue Smart's assets. Sources say the original petitioner, Catalyst trusteeship, accounts for nearly 250 crore of the claims. Shops wash away and buildings collapse as heavy rain triggers fresh landslides and flash floods at several places in Himachal Pradesh. Meteorological Department issues red alert in areas such as Kangra and Spiti. Landslide in Vaishno Devi kills 5 and leaves 14 people injured. Incessant rain causes a bridge in Jammu to wash away as water bodies swell. Hello and welcome. Very good evening. This is Profit 360 on NDTV Profit and I'm your host Malika Mishra. Along the next half an hour, we will be bringing you the latest on markets as well as national and international news to follow along. Let's begin with checking how the markets fared today. Benchmark indices fell sharply by over 1% as investor sentiment weakened after the US's draft notice on additional tariffs on Indian imports. Sensex dropped 910 points to 80,700 odd levels, while the Nifty declined to 24,690 levels. All sectors closed in red, barring FMCG. My colleague Puneet now joins in with more on this.
So it was a day which was under pressure for the Nifty, and we've seen that across the day today, with the advances just at roughly between 420 to 430 stocks and the declines at roughly around 1900 stocks today. We saw continuous pressure. The Nifty lost over 200 points from the day's high, and that pressure continued in the mid-cap and the small-cap index as well. For the Nifty specifically, it closed at its lowest point over the last 7 days, and barring the FMCG index, largely we saw all the other indexes being in the red today as well. Some notable stocks which were lower were Vodafone Idea as well as JK Paper. We saw some gains on stocks like IPCA as well as Craftsman Automation on the BSE 500, but that largely seems to be a day which was under pressure and continued to do so. Apart from that, we've seen Shriram Finance as well as Sun Pharma fall the most, and that was specifically for the Nifty. I mentioned Nifty fell 200 points from the day's high, but something like a mid-cap 150 saw drags from Vodafone Idea as well as FACT as well. The mid-cap 150 has fallen for the fourth consecutive day, and there seems to be any kind of lack essentially of a particular trigger to boost the markets going forward. Apart from that, we also saw the small cap 250 fall nearly 2%, and that was led by Swan Energy, Balrampur Chini Mills, amongst some of the key stocks that impacted the small cap index today. Finally, in terms of sectors, we've seen the realty index largely, along with the PSU bank and oil, have the major essentially drag on the Nifty, while we've seen that all sectoral indices largely continued to be under pressure throughout the day as well. The Nifty FMCG was the only one which offered some kind of solace, up 1% in trade today. We saw some positive gains on stocks like Britannia and as well as something like an HUL, but that largely seems to be one of the key aspects of a continuous pressure that we've seen across the market, and we'll be hoping of some positive start on Thursday morning, with tomorrow being a market holiday. So very happy Ganesh Chaturthi to all of you.
Thanks for that, Puneet. And as the market saw a significant amount of pressure today, Indigo is set to see a block deal on the 28th of August. Yes, sources tell us that Rakesh Gangwal Group is about to sell about 3.1% stake in the company. Let's go across to my colleague Somit for more details on what is to be expected from this block deal.
Yes, Indigo will remain in focus definitely on August 28th, given the fact that Rakesh Gangwal will be looking to sell close to 12.1 million shares, that is around 3.1% of the total equity. The offer size stands at close to 7,028 crore rupees, and the offer price is at 5,808 rupees, which is a discount of around 4% compared to the current market price. Morgan Stanley, JP Morgan and Goldman Sachs have been hired as the bankers to this deal, and post this stake sale, Rakesh Gangwal or his family won't be able to sell any stake for the next 150 days, which means that there is a 150 days lock-in period for the remaining part of the stake. Now, if you remember, Rakesh Gangwal has been continuously selling his stake in Indigo since the fallout that we had seen among the co-founders, that is Rahul Bhatia and Rakesh Gangwal. Now, this fallout was owing to disagreements over corporate governance and related party transaction, and the dispute had begun back in 2019. Gangwal had resigned from the board of directors of the company in February 2022, and he had stated that time that he will gradually reduce his equity stake over the next 5 years in the company. He held around 36.61% stake before the stake sales began, and currently, post this block deal on August 28th, he will be left out with just 4.78% stake. So far, he has knocked up close to 45,300 crore from the stake sales, and the residual 4.7% stake that Gangwal Group will hold in Indigo will be valued at close to 11,200 crore rupees.
Right, Somit, thank you so much for giving us those key details on this important block deal. But moving on, viewers, according